Hello, and welcome to the MB-330 Certification Preparation course. In this initial chapter, we set the stage for your journey into functional consulting by outlining the course syllabus and the technical landscape of Dynamics 365 supply chain management. This is an unofficial, independently produced course. It is not affiliated with, endorsed by, or connected to Microsoft Corporation in any way. All trademarks belong to their respective owners. This content is for informational and educational purposes only and should not be considered an official study guide provided by the exam sponsor. This course is meticulously designed to transform your understanding of enterprise resource planning, moving beyond surface-level navigation into the deep configuration of modules that drive modern supply chains. If you are aiming for the Microsoft Dynamics 365 Supply Chain Management Functional Consultant certification, you have come to the right place to sharpen your skills. We will cover the complete life cycle of product information management, starting from the foundational definition of items to the complexities of product variants and dimensional hierarchies. You will learn how to configure bill of materials, manage inventory valuation, and oversee the intricate procurement and sales processes that define a functional enterprise ecosystem. This training program acts as your blueprint for mastering the platform's standard capabilities, ensuring you possess the technical depth required to clear the examination with confidence. Our curriculum addresses the critical prerequisite knowledge matrix, which is essential for anyone aspiring to work as a professional consultant. We begin by examining cloud-based infrastructure and standard user interface navigation, including the effective utilization of personalizations and workspaces to improve user productivity. We then progress into the rigorous configuration mandates required for successful implementations, such as defining legal entity overrides, managing number sequence frameworks, and architecting security role assignments. Furthermore, we will delve into the technical reality of batch job executions and the importance of monitoring system performance through telemetry data. By the end of this course, you will be equipped to design comprehensive user acceptance testing scripts that account for edge cases in multi-site deployments and complex workflow logic. The strategy we apply throughout these lessons is grounded in the reality of cross-functional dependencies that permeate Microsoft Dynamics 365. You will see how inventory management is never an isolated function, but is deeply intertwined with general ledger postings, fiscal tax rule calculations, and intercompany trade configurations. We will explore how data entity migration templates within the data management workspace allow for scalable, fault-tolerant system setups across diverse client environments. Whether we are discussing master planning algorithms or advanced transportation logistics, the focus remains on standard practices that align with Microsoft's enterprise architecture standards. This course provides the structural foundation necessary to bridge the gap between abstract business requirements and actionable technical configurations. As we transition into the technical segments, keep in mind that the examination demands a precise understanding of how parameters ripple across the entire application. We will not merely describe functionality. We will dissect the configuration settings that control behavior in areas like warehouse management, inventory journals, and procurement and sourcing workflows. A functional consultant must be capable of translating procurement strategies into automated purchase order flows and matching these with vendor collaboration setups. Similarly, we will analyze the logic behind order promising, specifically looking at available to promise and capable to promise calculations, which are crucial for maintaining customer service levels. Prepare to engage with the material as if you were already in the room with a client, deciding which trade agreements or cycle counting processes will provide the most value to their specific operational challenges. See you in the next lecture. Welcome to the second module, where we will explore the foundational mechanics of product information management within Dynamics 365 supply chain management. Over the coming sessions, we will master the intricacies of creating products and variants to build a resilient supply chain foundation. Product creation in Dynamics 365 supply chain management serves as the bedrock for all downstream logistics and financial processes. When you approach the task of defining a new item, you are essentially establishing the constraints under which the entire system will eventually operate. A product can exist as a standalone item or as a product master, which acts as a template for more granular variations. Defining these entities requires a meticulous approach to item identifiers, search names, and human-readable descriptions. These metadata fields might seem trivial at the project's start, but they dictate how effectively inventory managers interact with the system later on. You must also select appropriate tracking parameters early, as changing dimensions like batch or serial tracking after initial transactions have been posted is an architectural headache you want to avoid. The distinction between a product and a released product is crucial here, as the former exists at the global level, while the latter is scoped to specific legal entities. By maintaining a clean global product definition and strictly managing the release process, you ensure consistent master data standards across complex, multi-company environments. Product variants offer a sophisticated way to manage complexity without ballooning your item master with thousands of redundant records. By utilizing product masters, you define a single entity that supports various combinations of color, size, style, and configuration dimensions. When you link these dimensions, the system generates the necessary variants that allow for high-fidelity inventory tracking without manual intervention. Think of this as defining the business logic for how a single physical product might present itself differently to the market. For instance, an apparel company might sell one shirt model that varies only by color and size. Rather than creating a unique item number for every permutation, the product master handles the logic. This design choice simplifies reporting and allows for centralized maintenance of base product attributes. When you configure these dimensions, consider them carefully because they dictate how the MRP engine groups demand and how the warehouse management module structures its storage logic. A well-constructed variant model translates directly into cleaner inventory transactions and more intuitive user interfaces for the floor personnel. The workflow for creating a product requires you to carefully map the unit of measure conversions and default order settings to the unique needs of your supply chain. You must determine the purchasing, inventory, and sales units for each product, as these rarely align perfectly in real-world scenarios. For example, you might purchase a raw ingredient in tons, but stock and sell it in kilograms, requiring an accurate conversion factor within the system configuration. Furthermore, settings such as site and warehouse parameters must be established to ensure the system knows where to look for stock and how to replenish it. If your business involves weight-based commodities, you will also need to engage with catch weight scenarios, which introduce another layer of unit logic. These configurations are not merely static settings. They are the parameters that the system logic uses to calculate lead times, quantity constraints, and reorder points. Ignoring these details during the initial setup will inevitably lead to discrepancies in procurement and sales processes, requiring expensive manual workarounds later. Configuration of these products requires a rigorous validation of all underlying parameters, including the orchestration of legal entity overrides and number sequence frameworks. Because Dynamics 365 is a multi-tenant and multi-legal entity platform, you need to ensure that security roles and batch execution schedules are appropriately assigned to prevent unauthorized modifications. The configuration layer also extends to general ledger postings, where inventory valuation methods and tax rule calculations are ultimately linked to the product. Your product definitions are intimately tied to intercompany trade configurations, meaning that a mistake in your initial product setup propagates throughout the entire enterprise network. As you progress, you must treat these setups as living entities that require performance monitoring. By utilizing telemetry data, you can identify if a particular product dimension or tracking configuration is causing bottlenecks in the database lookup operations. Experienced functional consultants always design their user acceptance testing scripts to cover these edge cases, ensuring that multi-site deployments and data entity migrations remain stable and scalable. I will see you in the next session. Welcome to our deep dive into product information management, specifically focusing on the critical architecture of product dimensions and groups. Understanding these structures is essential for anyone aiming to master the MB-330 exam and effectively manage supply chain logic in Dynamics 365. In this session, we will explore the foundational structures that define how Dynamics 365 treats your inventory, moving beyond simple data entry into the realm of architectural governance. When you define a product, you are not merely creating a record. You are assigning a set of behaviors that dictate the lifecycle, valuation, and physical constraints of that item across your entire supply chain. At the heart of this system lie three pillars: the storage dimension group, the tracking dimension group, and the item model group. Each serves a distinct purpose in partitioning information, yet they are inextricably linked through the product record to enforce consistency across transactional boundaries. If you get these configurations wrong at the beginning, you face significant technical debt, as these dimensions are often locked once the product has seen its first inventory transaction or financial movement. Storage dimension groups are our first point of focus because they define the physical footprint of an item within the internal logistics network. By configuring dimensions like site, warehouse, location, and license plate, you are essentially determining the granularity of your inventory visibility. If you decide that an item needs to be tracked at the location level, you are forcing the system to validate that every inbound and outbound transaction moves through a specific coordinate in your warehouse. The license plate dimension is particularly powerful, as it allows for the tracking of a specific container or pallet as a single unit, which is a prerequisite for advanced warehouse management processes. As you design these groups, consider the overhead. Adding dimensions increases the complexity of the data model and the effort required for manual inventory counts. You want to match the storage dimension granularity to your actual operational needs without burdening your warehouse staff with superfluous data entry. While storage dimensions handle the where, tracking dimension groups address the what and who through serialized or batch-controlled inventory. When you enable batch tracking, you are instructing the system to capture information about specific production runs or expiration dates, which is vital for quality control and lot traceability. Serial number tracking, conversely, allows you to identify unique individual units, a necessity for high-value items or complex equipment that requires long-term service history. An often overlooked aspect here is the owner dimension, which is critical in scenarios involving consignment inventory where you must logically separate goods owned by your vendors from your own assets. Once you toggle these checkboxes, you effectively change the primary key logic of your inventory transactions. Remember that these settings dictate whether the system will prompt the user for this input during every pick, pack, or receipt operation, thereby hard-coding your traceability policy directly into the user experience. Item model groups provide the overarching financial and operational logic for your items, governing how the system calculates costs and handles inventory shortages. This is where you define your costing methodology, whether you prefer standard cost, FIFO, LIFO, or weighted average. Each method changes the outcome of your balance sheet, and making the wrong choice here can lead to erroneous financial reporting that is difficult to untangle later. Furthermore, the item model group parameters determine whether you allow negative physical inventory, which essentially allows transactions to proceed even if the current on-hand quantity is zero, often used to bypass strict timing issues in busy warehouses. You also manage quarantine policies and physical update requirements here, which act as safety catches for your warehouse operations. Managing these groups requires a close partnership with your finance team, as the choices made here represent the core intersection between supply chain activities and general ledger integrity. When we transition to the actual configuration within Dynamics 365, we must remain vigilant regarding the legal entity context and data consistency. Many of the groups we have discussed are global or shared, but their impact is local to the legal entity where they are applied. Administrators must ensure that number sequences for batches and serial numbers are robust enough to prevent collisions, especially if you move toward a highly automated environment where batch jobs manage inventory updates. When you deploy these configurations, you are effectively building a state machine for every item. Any deviation from policy means that automated processes, like master planning or warehouse work generation, might fail to execute as expected. Consequently, a functional consultant's role is to ensure these groups are designed with edge cases in mind, such as how an item might behave during a transfer order between two sites with different dimension group settings. As you advance your implementation design, keep a close watch on the system's performance and the integrity of your relationships between inventory and financial dimensions. Every time you add a dimension or enable a feature like batch tracking, you are adding rows to tables that may grow to contain millions of records. High-volume systems require careful pruning of old data and the use of telemetry to monitor for locking contention during large-scale inventory journals. Your goal is to build a configuration that is both flexible enough to handle the realities of your supply chain and rigid enough to keep data accurate for auditing. If you maintain clarity in your dimension groups and model groups, you create a foundation that will stand up to the rigors of multi-site deployments and complex intercompany trade. See you in the next session. Welcome back to the course, where we will now shift our focus to the structural heart of manufacturing, bills of materials. This chapter will provide you with the architectural knowledge required to model complex assemblies within Dynamics 365. A bill of materials in Dynamics 365 supply chain management acts as a structured list of the components, subassemblies, and raw materials required to produce a finished product. At its core, this hierarchy dictates how the system translates a production order into specific material requirements, ensuring that procurement and manufacturing teams know exactly what to source. Defining a BOM is not merely about listing items. It is a technical exercise in setting consumption factors, scrap percentages, and validity periods. When you define a line item, you must distinguish between standard elements and phantom components, which are used to group items for logical planning without forcing an unnecessary physical intermediate assembly step. The power of this structure lies in its ability to support multi-level production, where a subassembly is triggered automatically, cascading requirements down to the lowest level of the supply chain. To manage engineering changes effectively, the system employs the concept of BOM versions, which allow for date-effective and quantity-effective variations. By decoupling the BOM structure from the version, you can prepare for seasonal shifts or schedule design updates without deleting historical manufacturing data. Every line within a version requires precise configuration regarding its line type, such as whether a material is consumed via manual batch reporting or automatically through backflushing. Furthermore, you must define resource consumption links that tie specific raw materials to precise steps in the production route. This ensures that the system does not just demand materials in isolation, but understands that specific items are required only at the milling or assembly workstation. Such granularity is essential for cost management, as it enables the system to track the precise financial impact of material variance against standard costs. Implementing these structures requires careful attention to the underlying system parameters that govern data integrity across legal entities. Because BOMs are often shared or copied across sites and companies, you must establish robust number sequence frameworks and ensure that security rules restrict unauthorized modifications to production structures. These configurations are deeply linked to broader enterprise settings, including inventory valuation models and tax rules that calculate costs at each stage of the life cycle. For instance, if you configure a phantom BOM incorrectly, you might find that inventory valuation at the intermediate level becomes inflated or misrepresented due to improper alignment with ledger posting profiles. You must also consider the cross-functional nature of this data, specifically how intercompany trade setups affect the transfer of BOM components across geographically separate warehouse locations. For those operating in complex multi-site environments, the maintenance of BOMs is a continuous process of optimization and validation. Functional consultants must design user acceptance testing scripts that specifically target edge cases, such as fractional consumption in metric units or irregular scrap factors that can cause systemic inventory discrepancies. Utilizing the data management workspace for migration is the standard practice, requiring clean, standardized entity templates to prevent the injection of corrupted hierarchy structures. Administrators should monitor system performance telemetry to identify potential bottlenecks caused by overly deep or circular BOM references during the master scheduling run. By keeping these structures lean and well documented, you ensure that the enterprise resource planning engine remains responsive regardless of the scale of your production operations. I will see you in the next lecture. Welcome to the section on cost groups configuration, where we will examine how to categorize manufacturing and procurement expenses for precise financial reporting. By the end of this module, you will understand how to build a robust foundation for variance analysis and cost roll-ups in Dynamics 365. Cost groups serve as the primary mechanism for segmenting expenditures within the supply chain, acting as the fundamental building blocks for cost roll-ups and overhead calculations. When we configure a cost group, we are essentially defining a bucket that classifies specific elements of an item's production or acquisition cost. By assigning a cost group type, such as direct materials, direct manufacturing, direct outsourcing, or indirect, we enable the system to treat these costs differently when calculating total lead costs or applying overhead burdens. This level of granularity is not merely about organization. It is about providing the visibility necessary to perform detailed variance analysis later. Without this structural clarity, Attempting to reconcile manufacturing variances becomes an exercise in guessing which cost components deviated from the standard. The architecture of cost groups allows you to isolate material costs from labor costs, which is essential for businesses that need to understand which part of their production process is becoming more or less efficient over time. Linking these groups to the costing sheet is where the true power of this configuration becomes apparent. The costing sheet acts as a structural representation of your company's cost accounting logic, where you define how overheads are distributed across these various cost groups. For instance, if you define a specific cost group for direct labor, you can subsequently configure a surcharge or rate-based overhead to be applied only to that group. This allows for precise calculations, such as assigning facility electricity costs based on the direct manufacturing hours reported for a finished good. If you fail to map your cost groups accurately within the costing sheet, the calculated overhead will either be missing or incorrectly distributed, leading to inaccurate standard costs. By maintaining a clean relationship between cost groups and the costing sheet, you ensure that the BOM calculations reflect the actual economic consumption of resources. It is this systematic aggregation that transforms raw transactional data into meaningful profitability insights at the finished good level. Configuring these settings requires a disciplined approach, especially when dealing with the cross-functional dependencies inherent in Dynamics 365 supply chain management. You must validate the underlying parameters carefully, as these configurations interact directly with general ledger postings, inventory valuation rules, and even intercompany trade agreements. For example, if you change a cost group assignment, you are effectively shifting how future inventory valuations and purchase price variances are recorded in the general ledger. Administrators should also be mindful of number sequence frameworks and security rules, ensuring that only authorized personnel can modify these foundational accounting structures. In multi-site deployments, you should pay particular attention to how these cost groups behave across different legal entities, as a misalignment here can lead to inconsistent reporting across the enterprise. Always test your configuration changes in a sandbox environment before applying them to production, especially given how these settings influence downstream workflows and data entity migrations. Complexity of these setups increases as you move toward more sophisticated manufacturing environments involving complex routing or outsourced services. You might find yourself needing to create distinct cost groups for different types of subcontracted work to ensure that the costs associated with outside services are properly categorized versus internal labor costs. This distinction is vital for maintaining an accurate ledger, as auditors often require clear documentation on how outsourced expenses are handled in the standard costing model. When monitoring the performance of these roll-ups, look for bottlenecks in the batch processing of cost estimates, as poorly configured costing sheets can significantly increase the time required for system calculations. Utilize the available telemetry data to evaluate the efficiency of your costing processes, and do not hesitate to refine your cost group structure if the initial design proves too cumbersome for your current operational needs. A well-designed cost group strategy is fundamentally about reducing complexity while maximizing the quality of the financial data produced by your supply chain. I will see you in the next lecture. Welcome to our detailed exploration of unit sequences within the framework of Microsoft Dynamics 365 Supply Chain Management. In this module, we will examine how to define hierarchical packaging structures to facilitate efficient warehouse operations. At its core, a unit sequence group serves as the fundamental bridge between physical inventory reality and the digital structure of the ERP. When you consider the life cycle of a product moving through a warehouse, it rarely exists solely in one unit of measure. You might receive goods in pallets, hold them in cases, and eventually ship them in individual pieces. The unit sequence group dictates the hierarchy through which the system evaluates these conversions. By defining these levels, you enable the mobile device and warehouse management system to understand exactly what a scan represents, whether it is a full pallet or a single unit. This configuration is not just about organizational clarity. It is a prerequisite for the system to perform accurate location directive matching during both inbound putaways and outbound picking workflows. When you accurately align these hierarchies, you effectively reduce the cognitive load on warehouse personnel, as the system provides clear prompts based on the sequence defined within the group. The mechanics of this implementation require a precise definition of unit conversion factors. You must ensure that the base unit, typically the smallest stock-keeping unit, is correctly related to the higher order containers through distinct mathematical ratios. If you fail to configure these factors, the system will be unable to calculate the aggregate quantity when a user scans a license plate, often leading to inventory discrepancies or system errors that halt automated processes. Furthermore, assigning default units for specific warehouse processes, such as receiving, picking, and even cycle counting, further refines the system behavior. By setting these defaults, you remove ambiguity from the mobile device entry process, ensuring that the warehouse clerk is prompted for the most logical unit relative to the operation being performed. This is where the configuration moves from theoretical modeling to actionable, repeatable efficiency. Barcode associations represent another dimension of this setup that is frequently misunderstood or underutilized. By linking GS1 standard formats, such as GTINs, to specific units within the sequence, you enable the warehouse management mobile app to interpret incoming data regardless of the package size scanned. This capability is paramount for streamlining automated data capture and, more importantly, eliminating the common errors associated with manual keystroke entry. A system that cannot automatically recognize that a specific barcode equates to a pallet of 12 cases will invariably force a manual override, which interrupts the flow of goods and increases the probability of human error. When the barcode is correctly mapped to the hierarchy, the system can parse the data in real time, validating the scan against the expected quantity and unit, which makes the entire material handling process more resilient. The complexity of these sequences also touches upon the technical requirements for validation and cross-functional dependency. When you define these parameters, you are indirectly influencing general ledger postings and inventory valuation, as the system must accurately multiply costs based on the quantity represented by the unit of measure. This is particularly relevant in intercompany trade, where unit definitions must be consistent across legal entities to prevent valuation mismatches and tax calculation errors during cross-border replenishment. Furthermore, as an administrator or consultant, you must look beyond the initial setup and consider the operational lifecycle. This includes managing number sequence frameworks that assign unique identifiers to the units and packages, as well as establishing security rules that restrict who can modify these critical master data structures. The interplay between these settings and batch execution schedules ensures that the warehouse remains a high-throughput environment rather than a bottleneck. For those involved in complex, multi-site deployments, the responsibility extends to rigorous user acceptance testing. It is rarely sufficient to simply configure a unit sequence in a sandbox. You must simulate edge cases such as partial pallet arrivals, units that are broken down into smaller components, or scenarios where a single product may have varying unit sequences based on the warehouse's specific handling requirements. Utilizing the data management workspace to migrate these entities is standard practice, but the data must be validated against real-world workflow condition logic to ensure the logic holds under stress. When moving these configurations into production, monitoring for performance bottlenecks, particularly regarding how the system handles large unit conversions during wave processing, is an essential task. A robust, fault-tolerant enterprise resource planning ecosystem is achieved only when these configurations are verified against both technical constraints and the operational realities of the shop floor. See you in the next lecture. Welcome back. In this session, we will examine how product lifecycle states exert control over the operational viability of your inventory items. Product lifecycle states are a mechanism in Dynamics 365 supply chain management that allows you to manage the transactional availability of products throughout their existence. By defining states like design, active, or obsolete, you create a gatekeeping system that prevents users from accidentally performing invalid actions on items. From a system design perspective, these states act as a set of rules that override standard behavior, effectively modifying the constraints of your supply chain processes. When you configure a state, you are essentially determining whether that product is eligible for procurement, manufacturing, or sales activities. This ensures that a product in the prototype stage cannot be accidentally included in a high-volume sales order, which would otherwise complicate your physical fulfillment and inventory reconciliation processes. Maintaining this level of rigor is vital for organizations that need to uphold strict governance over their master data, especially when dealing with complex engineering changes. When we look under the hood of these configurations, the feature is highly configurable based on business policy. You choose to either permit a process, block it entirely, or trigger a warning that prompts the user for a more conscious decision. For instance, if a product is marked as blocked, you can configure the system to prevent it from appearing during the firming of planned orders in master planning. This is a critical distinction because it prevents orphan purchase orders or production orders from being triggered for discontinued inventory. Furthermore, these states are deeply integrated with engineering change management, allowing you to link the state transition to an approval workflow. This creates a logical bridge between engineering, procurement, and warehouse operations, ensuring that the entire lifecycle is synchronized. If you fail to account for these dependencies, you risk having active inventory valuation occurring for items that should have been retired months ago. The actual configuration of these states involves several layers of careful planning. You start by defining the lifecycle state itself, but the power resides in the toggle switches that define the behavior for each transactional module. You must verify that your security rules allow users to modify these states, as you do not want warehouse staff accidentally reverting a product to an active state while it is in the middle of a decommissioning phase. Additionally, when managing these states in a multi-site deployment, you must account for legal entity overrides. A product might be obsolete in one country's regulatory environment while remaining active elsewhere, necessitating a clear strategy for how you map these states to specific entities. You should always test these configurations using your data management workspace to ensure that your migration and update templates respect the hierarchy of these state rules. Ignoring these foundational elements often leads to data inconsistencies that are expensive to resolve once the system reaches a point of high transaction volume. Consider the technical implications when these states interact with the general ledger and inventory valuation methods. If a product state is changed to blocked, it effectively removes the item from the available supply planning, but does not automatically liquidate any remaining on-hand stock. You must be prepared to handle the valuation and possible write-off of the remaining inventory, which may require manual journal adjustments or specific cost calculation routines. Consultants often overlook the fact that these states are static, meaning they do not automatically transition based on time. You must use recurring batch jobs to automate status changes, such as moving an item from active to obsolete based on an expiration date. When designing these automated processes, prioritize telemetry and logging. If a background job fails, the downstream impact on your procurement and master planning signals could be severe enough to disrupt your entire supply chain flow for several days. We will pick up our next topic shortly. Welcome back. In this lesson, we will explore the structural hierarchy of warehouse management in Dynamics 365, focusing on defining sites, warehouses, zones, and locations to create a functional spatial topology. When architecting a warehouse in Dynamics 365, you must first understand the fundamental hierarchy that anchors all inventory operations. At the top level, the site represents a geographically distinct location that typically aligns with a specific legal entity or a set of legal entities sharing logistics operations. Once the site is established, you define the warehouse, which acts as the primary container for inventory. Within the warehouse, clarity is achieved through the use of zones, which are logical groupings of locations that allow you to segment the warehouse space for specific operational purposes, such as picking, bulk storage, or staging. Effective segmentation ensures that your inventory management processes, like wave processing or cycle counting, remain performant by limiting the scope of work to relevant areas within the facility. Once you've defined your zones, the next layer of complexity involves configuring location profiles and location formats. A location format is essentially a naming convention that guides the system in interpreting how to address physical spots, such as aisle, rack, shelf, and bin. This systematic approach is vital for warehouse staff, as it provides a predictable mental model for navigation. Furthermore, location profiles are where you define the behavioral characteristics and constraints of these locations. You might designate a location type as a bulk location, a picking location, or a staging area, each carrying specific system rules. These profiles also store critical metadata regarding weight and volume capacities, which serve as the foundation for the system's underlying put-away logic. The interplay between these structural components and the system's constraint checking is what prevents operational errors, such as overloading a rack that lacks the structural support for heavy pallets. When you define a location profile, You are instructing the Dynamics 365 warehouse management engine on how to handle ingress and egress at that specific coordinate. If a system-directed task attempts to put away an item into a location that is already at its volumetric capacity, the system evaluates the profile settings to determine the next best action. This logic is not just a passive check. It is an active constraint that ensures inventory movement remains realistic within the physical constraints of your facility. A well-configured system acts as a digital twin of the actual warehouse, allowing the business to rely on data rather than physical inspection. Beyond physical configuration, managing warehouse entities requires a rigorous attention to underlying dependencies. You must consider legal entity overrides, as your global inventory strategy might require specific warehouses to interact differently with the general ledger or tax calculation engines. The accuracy of your inventory valuation depends on the correct warehouse setup, as some valuation methods are sensitive to the site and warehouse dimensions. Furthermore, when implementing these configurations, you must ensure that your number sequences and security roles are correctly assigned to facilitate the necessary administrative tasks. Neglecting these systemic configurations often leads to bottlenecks where users are faced with permission errors or sequence gaps during complex multi-site inventory transactions. As you transition from design to user acceptance testing, you must prioritize edge cases, such as identifying how cross-company inventory transfers will impact your multi-site deployment. Functional consultants should iterate on these configurations using the data management workspace to migrate templates, ensuring that the defined zones and location formats are consistent across your development, test, and production environments. Automating this deployment process via data entities significantly reduces the risk of human error, which is particularly relevant in complex environments with thousands of unique storage locations. Continuous monitoring of telemetry data will reveal if your zone-based strategies are genuinely improving efficiency or if the logic requires refinement to optimize travel paths for your warehouse personnel. By maintaining a clear and structured hierarchy, you create a system that is both scalable and capable of supporting complex, enterprise-grade logistics workflows. See you in the next lesson. Welcome back. In this section, we are diving into the mechanics of inventory movement journals and how they facilitate precise financial control over stock fluctuations. Inventory movement journals serve as a fundamental mechanism in Dynamics 365 supply chain management for the controlled introduction, removal, or transfer of stock. Unlike standard counting or adjustment journals that often rely on predefined inventory posting profiles, the movement journal requires the explicit manual entry of an offset general ledger account. This design choice is critical because it forces a direct linkage between inventory value changes and specific financial dimensions, such as cost centers, departments, or individual projects. By requiring this manual specification, the system ensures that every movement is accounted for where it logically belongs, rather than simply hitting a generic inventory adjustment account. From a functional perspective, you are essentially controlling the financial impact of your physical warehouse movements at the point of origin. Configuring these journals requires a disciplined approach to system administration and financial compliance. A functional consultant must first define unique journal names that align with organizational processes, ensuring that the vouchering series and user restriction policies are properly mapped. You should consider how security roles interact with these journal names. By leveraging technical restrictions, you can prevent unauthorized users from posting into restricted ledger accounts. It is also common practice to set up batch job execution schedules for repetitive movements, which helps reduce the manual burden while maintaining a consistent audit trail. Remember that the integrity of your financial reporting depends entirely on the accuracy of the underlying parameters, such as the legal entity overrides and the number sequence frameworks that govern each unique posted transaction. When we look at advanced use cases, the movement journal becomes an essential tool for initializing opening balances during a system go-live or handling complex legacy data migrations. If you need to bring in stock that does not have a purchase order or a production order, the movement journal provides the cleanest audit path. Similarly, you will often find this feature being used to handle ad hoc write-offs for goods that have been damaged in the warehouse or have reached their end-of-life status. In these scenarios, specifying the offset account allows you to expense the loss immediately to a specific department's budget. This granularity is particularly useful in multi-site deployments where inventory value differences need to be reflected in separate geographic or operational profit centers. You must also account for cross-functional dependencies that can complicate these seemingly simple transactions. Every posting into an inventory movement journal triggers automated logic within the general ledger, requires tax rule validation, and potentially affects your inventory valuation methods like FIFO or weighted average. If you are operating in an intercompany trade environment, the movement of stock might necessitate secondary entries to maintain global balance. It is therefore critical to design your user acceptance testing scripts to target these edge cases, such as posting journals while intercompany syncs are active or testing how workflow condition logic handles large-scale adjustments. Using the data management workspace to import these journals is a best practice, but ensure that your templates are validated against existing inventory dimensions to avoid corrupting your valuation framework. To ensure the system remains scalable, administrators should continuously monitor performance, particularly when large volume transactions hit the ledger simultaneously. Telemetry data can help identify bottlenecks in how the system handles the reconciliation between physical warehouse movements and financial postings. If you notice delays during the posting process, check if the issue resides in complex financial dimension validation or an excessive number of lines within a single journal batch. A well-designed ERP ecosystem is one that anticipates these constraints and builds in fault tolerance through properly managed journal naming and periodic data cleanup. By mastering the movement journal, you are not just recording stock, you are actively managing the financial health of the supply chain. I will see you in the next lecture. Hello. Today we are going to explore inventory adjustment journals and how they help maintain accurate data in Dynamics 365 supply chain management. Inventory adjustment journals serve as a fundamental mechanism for correcting stock discrepancies that inevitably arise in any complex physical environment. When you identify that the system-recorded inventory level does not match the physical quantity sitting on the warehouse shelf, an adjustment journal is the appropriate tool to reconcile these figures. Unlike movement journals, which allow you to manually specify the offset ledger account, the adjustment journal leverages the item posting profile. This automated behavior is critical because it ensures that the financial offset is consistently applied to the accounts configured in your general ledger. By relying on preset posting profiles, you effectively isolate the inventory valuation process from human intervention, thereby minimizing the risks associated with manual account selection. This approach maintains the integrity of your financial records while preserving the audit trail required for cost accounting compliance. Setting up journal names involves a systematic configuration of several underlying parameters that ensure your operations remain controlled and traceable. You must first define the journal name, which acts as a container for your adjustment entries, and assign it to a specific journal type related to adjustments. Within these settings, you should consider enabling workflow approvals if your organization requires a multi-level sign-off process before stock changes are reflected in the financial statements. Furthermore, you will define how detail is summarized when posts are transferred to the general ledger, which is a key decision point for performance and reporting granularity. Default dimension values can also be pre-populated here, ensuring that every adjustment entry carries the necessary financial dimensions for accurate reporting, such as cost centers or departments. Proper configuration of these journal names provides the structural foundation required for reliable, repeatable, and compliant inventory management practices. Security and governance frameworks play a mandatory role in the life cycle of adjustment journals to prevent unauthorized tampering with stock balances. You should implement a rigorous security model where only authorized personnel are granted the privilege to create, validate, and post these journals. Because inventory adjustments directly impact the inventory valuation accounts and the cost of goods sold, unrestricted access can lead to significant financial inaccuracies. You must define security rules that limit visibility and write access based on the least privilege principle, ensuring that functional consultants and warehouse managers only interact with the data necessary for their specific remits. Furthermore, auditing should be enabled on the journal tables to track who initiated an adjustment and when it was processed. This layer of oversight is non-negotiable in an enterprise resource planning environment where accountability is the cornerstone of trust in the underlying data. Configuration mandates a comprehensive approach that extends far beyond the journal name setup to include legal entity overrides and batch processing. When dealing with multi-site deployments, you must account for specific unit of measure conversions and tracking dimension requirements that might vary by legal entity. It is common to utilize the data management workspace to import bulk adjustments, which requires well-defined data entity migration templates to protect data integrity. Your administrators should also implement batch job execution schedules for non-urgent adjustments, ensuring that resource-heavy postings do not conflict with peak operational hours in the warehouse. Additionally, you need to consider how intercompany trade configurations interact with these adjustments, as an adjustment in one entity may require visibility or alignment in another. Maintaining a holistic view of these cross-functional dependencies is what distinguishes a robust, scalable system from one that suffers from perpetual data inconsistencies. Functional consultants must focus their efforts on designing thorough user acceptance testing scripts that anticipate edge cases, particularly those involving complex inventory dimensions. An effective test script will attempt to post adjustments that violate standard business rules, such as negative inventory on an item that prohibits it, to verify that the system validation logic triggers the expected error messages. You should pay particular attention to how the system handles weight-based items or items subject to complex tracking dimensions, as these often reveal hidden configuration gaps. By simulating real-world scenarios, including concurrent processing and intercompany order conflicts, you validate that your ERP ecosystem is indeed fault-tolerant. This proactive testing phase is essentially the final quality gate before you migrate these journal configurations to a production environment. Only through such rigorous verification can you be certain that your inventory figures truly reflect the physical reality of the organization. See you in the next lecture. Welcome back. Today, we are stepping into the practical mechanics of cycle counting processes within the Dynamics 365 supply chain management environment. We will examine the architectural configuration and the operational workflows necessary to maintain perpetual inventory accuracy. Cycle counting is the cornerstone of maintaining a reliable warehouse, moving us away from the disruptive nature of annual physical inventories. In this system, we rely on mobile device workflows that guide warehouse workers through targeted counting tasks without requiring a facility-wide shutdown. The beauty of this approach lies in its dynamic nature, where we can trigger counts based on specific events rather than just arbitrary calendars. When we configure these cycles, we are essentially defining the business rules that dictate when a location or an item needs verification. This often involves setting up thresholds, such as waiting for a location to become empty, or observing when a stock quantity drops below a certain level. By automating the identification of these moments, we ensure that our inventory records remain a trustworthy proxy for the physical reality on the floor. To implement this effectively, we must look at the foundation provided by ABC classification, which allows us to prioritize high-value or high-velocity items, ensuring they are counted more frequently than slower-moving goods. Within the system, these periodic plans work in conjunction with our location settings to ensure that the process remains manageable for the staff. When a worker is assigned a counting task, the implementation of blind counting becomes a crucial security and accuracy feature. By forcing the worker to enter the physical quantity they encounter, rather than presenting them with the system-predicted value, we effectively minimize confirmation bias. This configuration ensures that the worker is actively verifying the contents of a bin, rather than unconsciously agreeing with a potentially outdated system record. If a discrepancy occurs, the tolerance logic immediately evaluates the variance against predefined rules, deciding whether to auto-approve the adjustment or escalate it to a supervisor for a recount. We must remember that this is not an isolated inventory feature, but rather one that sits deep within the broader warehouse management architecture. When a cycle count is active, the system employs real-time inventory locking, which prevents other warehouse processes like picking or replenishment from interfering with the integrity of the data being recorded. This necessitates a rigid underlying structure that includes properly defined number sequences, legal entity overrides, and secure role assignments that prevent unauthorized personnel from overriding count results. Furthermore, the impact of these adjustments cascades into the general ledger and the inventory valuation framework, meaning that every count has a direct financial consequence. As functional consultants or administrators, we cannot overlook the tax implications or intercompany trade impacts that these inventory movements might trigger. as these are often where the most subtle and damaging errors reside in a complex, multi-site environment. Managing these processes requires a shift in mindset from simple data entry to a holistic focus on system health and scalability. As you scale across multiple sites, you will inevitably encounter edge cases, such as timing differences and data entity migrations, or specific workflow conditions that test the limits of your initial setup. You should view the data management workspace as an essential tool for migrating these counting configurations predictably while maintaining the integrity of your master data. Monitoring performance here goes beyond just seeing if the jobs ran. It involves analyzing telemetry to identify bottlenecks that could delay stock updates across the enterprise. Ultimately, a successful implementation relies on robust user acceptance testing scripts that specifically target the exceptions, the counts that fail, the supervisors who need to intervene, and the sync issues between the warehouse and the financial modules. By designing for these complexities, we create an ERP ecosystem that is inherently more resilient and capable of supporting global supply chain requirements. See you in the next installment. Welcome back. Today we will navigate the technical intricacies of inventory valuation methods in Dynamics 365 supply chain management. Inventory valuation is essentially the systematic way we assign financial value to our assets as they flow through the supply chain. When you define an item model group, you are essentially choosing a cost flow assumption that governs how the system treats the monetary value of goods as they are issued or sold. Standard cost is perhaps the most rigid of these methods, as it relies on a predetermined value that remains fixed regardless of the actual purchase price. This forces your organization to track variances, the difference between the planned cost and the actual procurement cost, which serves as a primary tool for operational performance analysis. If your operation prioritizes precise budget control and simplified financial reporting, standard costing is often the default choice, though it requires meticulous maintenance of cost records and standard price updates. Moving beyond static standards, we encountered the perpetual inventory methods such as first in, first out, or FIFO. Under the FIFO paradigm, the system assumes that the oldest items in your inventory are the ones being consumed first, which usually aligns with physical goods flow in most warehouses. This method is particularly useful during periods of rising costs because it keeps the cost of goods sold lower, thereby inflating reported profit margins. Conversely, the weighted average method calculates costs based on the average cost of all available units in inventory, shielding financials from the volatility of individual procurement price spikes. Dynamics 365 executes this via the inventory recalculation or the formal inventory close process, which is a batch job that reconciles your physical transactions with their financial postings. The inventory close process is a critical architectural component that performs the actual matching of receipt transactions to issue transactions. Without this process running, your financial reports will rely on estimated costs rather than finalized, settled values. You must be aware that the system uses heuristic algorithms during this close to settle issues against receipts, ensuring that the cumulative quantity and value are balanced at the end of every period. If you are dealing with moving average, the system updates the inventory cost immediately upon a financial update, which is significantly different from periodic close-based methods. This real-time update capability is attractive for high-velocity environments, but requires disciplined data entry to avoid drastic fluctuations in asset valuation. Configuring these valuation methods involves more than just selecting a radio button in the item model group settings. You need to consider the broader impact on the general ledger, as every inventory transaction triggers financial entries that represent the movement of value across your chart of accounts. Furthermore, the costing sheet serves as the engine for applying indirect costs, such as labor overhead or machine utility, to your item costs. If your organization operates in multiple sites or legal entities, you must account for the complexities of intercompany trade, where prices might be set based on specific transfer pricing rules. Each of these components interacts with the valuation engine, and a misconfiguration in the taxing or ledger mapping can lead to discrepancies that are difficult to reconcile after the month-end close. For functional consultants, designing for these valuation methods requires a deep understanding of the data migration templates and the validation steps necessary to ensure integrity. You should always be thinking about how the system behaves under exceptional scenarios, such as when inventory is returned or when transactions are backdated. Multi-site deployments add another layer of complexity because you might have different valuation needs for different warehouses depending on their functional role within the enterprise. Always ensure that your testing includes high-volume transaction scenarios to verify that the batch jobs responsible for recalculations can handle the load without creating performance bottlenecks. Reliability in this area of the system is the cornerstone of trust between the warehouse operations team and the finance department. See you in the next session. Welcome back. Today, we are going to dive into the technical details of tracking dimensions in Dynamics 365 supply chain management. When we talk about tracking dimensions, we are primarily concerned with batch and serial numbers, as well as the owner identifier. These dimensions provide the granular level of visibility required for sophisticated supply chain operations. From a system architecture perspective, tracking dimensions are part of the dimension group assigned to a product, which dictates whether certain values are mandatory at the time of entry. If you designate a product as batch controlled, the system will prevent you from processing goods without a valid batch ID. This is a hard constraint enforced in the database schema, ensuring that data integrity is maintained across all inventory movements, journals, and production orders. As an architect or functional consultant, your primary task is to balance the need for traceability against the overhead of data entry for the end users. Number groups function as the automated engine for generating these identifiers, allowing you to define sequences for batch and serial numbers during production, receipt, or inventory adjustments. You should view these sequences as a foundational governance tool. They eliminate manual errors and ensure that every item across a multi-site deployment is uniquely identifiable. Once these sequences are configured, the system handles the persistence logic, meaning you don't have to worry about the underlying record generation once the framework is active. However, you must carefully plan your scope for these segments. You might define global number sequences, or you might find yourself needing legal entity overrides to comply with local regulatory requirements, particularly in industries involving food or pharmaceuticals, where traceability is not just a best practice, but a legal mandate. The interplay between batch tracking and shelf life management is where inventory logic becomes truly interesting. By integrating expiration dates, best before dates, and specific shelf life parameters, you allow the system to effectively manage the first expired, first out, or FIFO dispatching strategy. When a warehouse worker picks goods for a customer order, the system can automatically suggest the batch that is closest to its expiration date. This logic is not merely a suggestion, but a driver for inventory valuation and reduction of write-offs. When you configure quality orders, you are linking inspection requirements directly to these batches. If a batch fails an inspection, it can be marked as blocked, preventing it from appearing as valid stock in the available to promise calculations, thereby creating a robust firewall between non-conforming goods and the customer-facing supply chain. From a cross-functional perspective, these tracking dimensions do not live in isolation. They are deeply entwined with the general ledger and financial reporting. When you configure items to use serial or batch numbers, you are essentially defining the granularity of your inventory valuation. In some accounting setups, if you require cost tracking at the batch level, you must ensure that your system policies align with the inventory models you have chosen. Furthermore, when you deal with intercompany trade, you must ensure that the tracking dimension groups are consistent between the legal entities involved, or you will face synchronization errors during the posting process. This requires rigorous attention to the data entity migration templates you might be using to import these configurations, as any misalignment here can lead to downstream reconciliation nightmares that are difficult to debug in a production environment. Lastly, consider the performance implications of tracking at a high level of granularity. Every time you require a unique serial number for every individual item, you are effectively increasing the volume of rows in your inventory transaction tables. While modern high-performance databases handle this well, you must monitor for bottlenecks in ledger postings and inventory recalculation batch jobs. Use the telemetry tools available to analyze how the system performs during heavy load periods, especially if you have high-frequency warehouse movements. Functional consultants must design user acceptance testing scripts that account for these volumes and edge cases, such as split batch receipts or complex warranty tracking scenarios. If your configuration does not properly address the life cycle of these dimensions, you will find that the system becomes an obstacle to the business rather than a foundational enabler. See you in the next lecture. Hello? Today we are diving into the architecture behind purchase requisitions in Dynamics 365. This chapter focuses on the configuration required to bridge the gap between internal employee requests and formal procurement. Purchase requisitions serve as the formal intake mechanism for the procure-to-pay lifecycle, allowing internal staff to request materials or services before any legal commitment to a supplier is made. From a structural perspective, you should view the requisition as a staged document that undergoes validation before it evolves into a purchase order. The system allows for two primary input methods: catalog items managed via procurement categories, or free text entries for non-catalog goods. You must configure these procurement categories carefully because they dictate not only the financial accounts used for posting, but also which items are available for selection in the self-service web interface. If a category is not properly mapped to a vendor or an account structure, the requisition process will fail at the financial encumbrance stage, often leading to confusion during the month-end reconciliation process. Central to this module is the concept of purchasing policies, which act as the governing layer for the entire requisitioning process. You configure these at the organization level, or specifically for individual legal entities, defining who has access to which catalogs and what spending limits apply to specific users. Whenever a user submits a requisition, the system evaluates it against these policies to determine whether it requires a simple approval or an escalation to a higher management tier. This is also where you define consolidation rules, which are essentially batch-driven logic that groups line items from various requisitions into a single purchase order to take advantage of volume discounts. By automating this consolidation, you reduce the administrative overhead placed on purchasing agents, allowing them to focus on high-value negotiations rather than manual data entry. A critical technical component of the setup involves defining the hierarchical workflow that governs request approval. You need to map these workflows to the organizational nodes, ensuring that financial managers see requests that involve their cost centers, while project managers oversee those linked to specific project codes. When implementing these workflows, consider the use of business justification codes, which provide the audit trail necessary later in the general ledger reporting. These codes allow for precise cost allocation, turning a generic purchase into a trackable expense mapped directly to an internal budget. If you configure these incorrectly, you risk losing visibility into where capital is actually flowing, effectively decoupling the Procurement Act from the corporate budgetary control mechanism. Configuration must also account for the foundational setup surrounding number sequences and security roles. Each requisition document type requires its own number sequence, which helps in tracking compliance across large enterprises where thousands of requests might be generated monthly. Regarding security, you must use the role-based access control model to ensure that employees can only view or create requisitions for their own department or legal entity. If a user tries to access a catalog outside their assigned procurement policy, the system should prevent the line entry entirely, rather than failing upon submission. These constraints are vital for maintaining data integrity and ensuring that the procurement department retains centralized control over the vendor master and catalog management. Finally, you should consider the implications of your configuration choices on downstream processes like inventory valuation and tax calculations. When a requisition is approved and converted into a purchase order, the system pulls the defaulting dimensions from the procurement category setup. If your inventory valuation method is set to weighted average or FIFO, the link between the initial requisition and the final receipt is what informs the cost of goods sold. Testing these links within a simulated environment using user acceptance testing scripts is mandatory, especially in scenarios involving intercompany trade where one legal entity might be requesting goods from an internal warehouse. By ensuring that your parameters for tax rules and project associations are robust, you create an end-to-end ecosystem that is not only functional, but also audit-ready for regulatory requirements. I will see you in the next lecture. Welcome back. In this conversation, we are diving into the Request for Quotations module to understand how to manage competitive bidding and vendor solicitation effectively within Dynamics 365 supply chain management. The Request for Quotation, or RFQ, serves as the primary mechanism for soliciting pricing, delivery timelines, and contractual terms from multiple potential vendors simultaneously. At its core, the system allows a procurement professional to define a specific set of requirements and broadcast these to a selected group of vendors. By doing so, You move procurement away from ad hoc negotiations and into a structured, competitive framework that ensures better price discovery and risk mitigation. When you configure the RFQ process, you are essentially defining the parameters under which the organization will interact with its supply base. This requires careful consideration of how you want to score incoming bids and what specific templates will be used to communicate these needs to external partners. If you approach the configuration as a static setup, you will eventually find it brittle. Instead, treat it as a dynamic model that must reflect the changing requirements of your sourcing strategy. To make this functional, you must first address the underlying technical configuration within procurement and sourcing parameters. These parameters govern the behavior of the RFQ process, including the specific number sequences used to track documents throughout their lifecycle. Without a consistent number sequence, audits become difficult, and tracking the state of an active bid becomes practically impossible. Furthermore, you need to establish secure workflows that dictate who can create an RFQ, who can send it to vendors, and who maintains the authority to accept or reject a bid. Security roles in Dynamics 365 are granular, and you should ensure that the principle of least privilege is applied so that only the appropriate sourcing managers have the capability to finalize a purchase order from a bid. Overlooking these security assignments often leads to operational bottlenecks, where unauthorized users accidentally move requests into invalid states. A significant advantage of digital procurement is the integration with the vendor collaboration portal, which changes the dynamic of data entry. Rather than manual reentry of vendor responses, which is prone to human error, the portal allows suppliers to submit their pricing and delivery information directly into the system. This electronic submission is essential for maintaining data integrity and reducing the lead time associated with the procurement cycle. From an administrative perspective, you are responsible for ensuring that the vendor's portal access is correctly mapped to the legal entities that have permission to issue RFQs. When a bid arrives, the system validates the response against your set criteria, allowing you to use scoring heuristics to compare vendors. This comparison is not merely about price. It is about evaluating the total value, including lead times and service capabilities, which should be configured according to your business's specific weighting requirements. When looking at the broader ecosystem, the RFQ process does not exist in a vacuum. It is deeply intertwined with financial and inventory modules. Once an RFQ is accepted and successfully converted into a purchase order, the system must handle the corresponding general ledger postings to reflect the financial commitments. Simultaneously, if the purchase is for stock items, inventory valuation methods such as moving average or landed cost must be properly aligned with the figures provided in the bid. If you misconfigure these dependencies, you create a discrepancy where the cost recorded on a purchase order does not match the cost at which inventory is eventually valued in the warehouse. During the design phase of your implementation, you should run through edge cases, such as multi-site deployments where tax rules might change based on the delivery location to ensure your RFQ framework remains fault-tolerant and scalable. Finally, managing the performance of this module involves proactive monitoring of the system's telemetry and batch execution schedules. Since RFQs often involve processing large volumes of data, especially when solicitations involve complex bills of material, the background processes must be optimized to prevent system lag. You should pay particular attention to how the data management workspace is used to import or export bid data, as inefficient templates can consume excessive resources. Functional consultants should prioritize building robust testing scripts that simulate real-world vendor interactions, including scenarios where vendors decline particular lines or propose alternate products. By focusing on these architectural constraints and logical flows, you ensure that the procurement function remains not just a clerical process, but a strategic asset that supports the overall supply chain efficiency of the organization. See you in the next lecture. Welcome back. Today we examine the mechanics of purchase order creation within Dynamics 365 Supply Chain Management. A purchase order in the context of Dynamics 365 is far more than a simple electronic document. It serves as a formal, legally binding commitment between an organization and a supplier for the procurement of goods or services. When we structure these orders, we are essentially defining the parameters of a financial contract that must reflect precise data points, including specific items, defined quantities, agreed upon unit prices, target delivery dates, and the associated tax configurations. From the perspective of a functional consultant, our primary goal is to minimize transactional friction by leveraging default order settings and vendor trade agreements to automate as much of this data entry as possible. By ensuring these defaults are tuned correctly, we prevent the user from needing to manually populate fields that should be derived directly from the master data. This automation not only increases efficiency, but acts as a critical control mechanism to ensure that the purchasing process remains consistent across the legal entity. When we consider the broader architecture, we see that the procurement parameters dictate how the system handles the life cycle of these documents from the moment of creation until the final receipt. Consequently, the rigidity of your configuration determines how effectively the system can enforce the organization's purchasing policies without hindering legitimate business operations. To maintain financial integrity, we must implement matching policies that act as automated gatekeepers for the procurement lifecycle. The system provides the flexibility to define two-way matching, which compares the purchase order and the vendor invoice, or three-way matching, which additionally incorporates the product receipt into the validation process. These policies are essential for preventing overpayment by cross-referencing the quantities received against what was originally ordered and what the vendor has claimed on their invoice. We configure these parameters at the vendor account or the procurement category level, allowing for granular control based on the nature of the goods being acquired. If the discrepancy between the document attributes exceeds our defined tolerances, the system automatically flags the invoice for manual review, thereby protecting the ledger from unauthorized variances. Beyond mere validation, we must also consider the change management workflows that lock approved orders to prevent silent modifications. Any change to a critical line item, such as an alteration to unit price or quantity, necessitates that the order be unconfirmed and moved back through the approval workflow chain to maintain an immutable audit trail of the negotiation. The complexity of purchase order creation is further compounded by the various cross-functional dependencies that exist within the Dynamics 365 ecosystem. When an order is confirmed, it initiates a series of downstream events that affect the general ledger, inventory valuation, and tax rule frameworks. For businesses operating in multi-nation environments, this includes navigating the specific requirements of intercompany trade, where a purchase order from one legal entity automatically triggers a corresponding sales order in another. As administrators or consultants, we must ensure that our number sequence frameworks are robust and that security roles provide the appropriate scope of access for users executing these transactions. Furthermore, we should anticipate the performance implications of high-volume purchasing by utilizing batch job execution schedules to move heavy processing tasks outside of peak user hours. Functional consultants often design user acceptance testing scripts that target specific edge cases, such as multi-site delivery scenarios or complex workflow condition logic, to ensure that the system handles anomalies with grace rather than failing, which would create operational bottlenecks. Ultimately, our configuration decisions today will directly dictate the scalability and fault tolerance of the entire procurement process within your enterprise resource planning implementation. I will see you in the next lecture. Welcome back. In this session, we will examine the configuration and architectural requirements for enabling vendor collaboration within Dynamics 365 Supply Chain Management. Vendor collaboration is not merely a communication portal. It is an extension of your internal ERP data boundary to external entities. To implement this effectively, we must first focus on the provisioning of external user identities, which are typically managed through Azure Active Directory B2B integration. When you configure a vendor contact for collaboration, you are essentially creating an invitation lifecycle that must be tightly governed by security roles. These roles are pre-configured to ensure that a supplier can only access data pertaining to their own account, preventing cross-tenant data leakage. You must ensure that the security role assigned to these external users aligns with the specific actions they are permitted to perform, such as confirming purchase orders or submitting electronic invoices. If you fail to map these roles correctly, you jeopardize the principle of least privilege, which is critical in an enterprise environment where external exposure must be strictly minimized. Once the identities are provisioned, the focus shifts to the configuration of the vendor collaboration workspace parameters. This involves defining the specific purchasing and invoicing workflows that the vendor will interact with directly. You need to verify that your number sequence frameworks support the external document creation process, particularly when vendors propose changes to purchase orders. When a vendor interacts with an active request for quotation or updates an invoice, the system must translate these remote operations into valid internal ledger entries. This requires rigorous validation of legal entity overrides to ensure that tax rules and financial dimensions remain consistent across the exchange. Without these parameter configurations, the system may reject external updates, necessitating manual intervention that defeats the purpose of an automated collaboration portal. Complexity increases significantly when we introduce consignment inventory scenarios through this portal. In these arrangements, the vendor retains ownership of the inventory until it is consumed by your production or distribution processes. You must configure the portal to allow vendors to monitor consumption levels in near real time, which eventually triggers an automated ownership transfer. This process requires a sophisticated alignment between inventory valuation methods and your general ledger postings. If your inventory valuation is not properly synchronized with the consumption triggers, you will inevitably encounter discrepancies in your balance sheet and stock reporting. Always verify that your batch job execution schedules are optimized to process these movements accurately, as delays in these jobs can lead to significant reconciliation errors between your inventory records and the vendor's expectations. Finally, successful implementation demands a robust strategy for testing and performance monitoring as you scale. Functional consultants should approach this by designing user acceptance testing scripts that specifically target edge cases in multi-site deployments. You must validate your workflow condition logic to ensure that an approval process handles vendor input predictably across diverse operational requirements. Furthermore, as you manage data entity migration templates through the data management workspace, maintain a focus on the structural integrity of your configuration records. Administrators should treat the system's telemetry data as an essential feedback loop, identifying performance bottlenecks that could occur during high-volume document exchanges. By maintaining this analytical posture, you ensure that the vendor collaboration ecosystem remains both fault-tolerant and responsive to the needs of your extended enterprise supply chain. I will see you in our next session. Hello, and welcome to our deep dive into the mechanisms of procurement trade agreements. In this section, we will explore how to configure structured pricing and discount logic to automate your vendor negotiations within the supply chain. Procurement trade agreements in Dynamics 365 supply chain management function as the fundamental engine for automated cost calculation during the purchase order lifecycle. When you define these agreements, you are essentially formalizing the commercial relationship between your organization and your vendors. At the configuration level, we start with the price discount journal, which acts as the staging area for all pricing logic. You must specify the relation type, which determines whether the price or discount applies to a specific vendor, a group of vendors, or all vendors across the global address book. Similarly, we define item relations to decide if these rates apply to a single product, a product group, or the entire inventory catalog. This hierarchy ensures that the system resolves the most specific price first, adhering to the principle of least astonishment when procurement agents generate purchase orders. By setting these parameters correctly, you eliminate manual entry errors and ensure that negotiated rates remain consistent across your procurement department. Effective price management requires a granular understanding of discount types, which the system categorizes into line, multi-line, and total discounts. Line discounts are the most common application, providing a reduction in price based on the quantity purchased of a single item. Multi-line discounts introduce complexity by applying thresholds based on the cumulative quantity of a category or group of items, which can significantly alter the net cost of an order. Total discounts apply to the entire purchase order document, often acting as a final incentive to increase order volume. You must configure quantity thresholds carefully, as these trigger tier-based pricing models that reflect the reality of vendor supply contracts. Moreover, date effectivity is a critical parameter that dictates exactly when a price becomes valid and when it expires. Using date ranges allows you to plan for upcoming contract renegotiations or seasonal promotional periods without interrupting current operations. Beyond simple pricing, the procurement engine supports sophisticated functions like smart rounding rules and currency conversions to maintain financial precision. If you are dealing with international vendors, the system converts prices based on the exchange rates active on the order date, ensuring that your procurement costs remain accurate regardless of currency fluctuations. You should also consider the impact of legal entity overrides and number sequence frameworks that govern how these trade agreements are logged in the database. Security role assignments are equally vital. You want to ensure that only authorized procurement managers can publish or modify these agreements, preventing unauthorized cost inflation. During the implementation phase, batch job execution schedules must be verified to ensure that any pending updates or recalculations are processed in the background without impacting transaction performance. Always remember that these agreements do not exist in a vacuum, as they feed directly into your general ledger postings and inventory valuation frameworks. When we look at the cross-functional implications, the integration between trade agreements and tax rule calculations becomes paramount for compliance. If your tax configuration engine is not correctly aligned with the net discounted price, you might face discrepancies in your procurement audit trails. Intercompany trade configurations add another layer of complexity, requiring you to map trade agreements to intercompany vendors to keep margins controlled between business units. From an administrative perspective, you should continuously monitor for performance bottlenecks created by high-volume trade agreement updates. Using standard telemetry data, you can identify if large-scale imports via the data management workspace are causing latency, especially when dealing with complex multi-site deployments. Functional consultants must design robust user acceptance testing scripts that specifically target edge cases like overlapping agreements or invalid date ranges. By confirming that your workflow logic handles these scenarios gracefully, you can avoid common pitfalls that hinder the efficacy of your enterprise resource planning ecosystem. See you in the next lecture. Welcome back to our exploration of the Dynamics 365 supply chain management landscape. Today, we are focusing specifically on the structural mechanics of procure-to-pay workflows. In any enterprise resource planning system, the procure-to-pay workflow serves as the connective tissue between initial demand and final financial settlement. When we talk about these workflows in the context of the MB-330 exam, we are essentially discussing the automation of sequential document routing. This process is not merely about moving a piece of digital paper from one user to another. It is about enforcing governance and ensuring that every expenditure aligns with organizational policy. A well-designed workflow utilizes condition-based routing where the system evaluates specific data fields such as monetary value, department dimensions, or project codes. These variables dictate precisely who bears the responsibility for approval at each stage. By configuring these dynamic assignments, you reduce manual intervention and create a transparent trail of accountability that auditors will inevitably scrutinize. To prevent the administrative paralysis that often plagues manual approval chains, escalation policies are an essential component of your workflow design. Without these, a document sitting in the queue of an absent manager could halt the entire procurement cycle, leading to stockouts or delayed production. You should configure these policies to automatically reroute or elevate the approval task if it remains unaddressed beyond a predefined temporal threshold. Furthermore, you can implement automated actions where the system takes a decision based on heuristic thresholds. For instance, a purchase requisition under a certain financial limit might auto-approve if it adheres to pre-established budget constraints. This effectively separates high-risk, high-value transactions from routine operational spending, allowing the system to handle the low-level noise while keeping the human experts focused on the critical decisions. Financial oversight is maintained through the integration of expenditure reviewers, who act as the final gatekeepers before a commitment hits the general ledger. The financial architecture allows you to define who possesses the authority to perform these reviews, ensuring that those responsible for specific budget centers are the ones validating the transaction. Before moving forward, you must ensure that your system parameters are strictly validated, including the legal entity overrides, number sequence frameworks, and the necessary security role assignments. A common point of failure in real-world implementations is the neglect of the batch job execution schedule. If your workflow processes are not running on a consistent, optimized schedule, document status updates may lag, causing issues in inventory valuation or tax calculations. You must treat these workflows as live services that require monitoring via telemetry data to identify and rectify performance bottlenecks proactively. It is vital to recognize how these workflows intersect with the broader supply chain ecosystem, particularly regarding inventory valuation and intercompany trade. When a purchase order moves through a workflow and eventually reaches a confirmed state, It triggers specific postings in the general ledger that fluctuate based on your inventory costing method. If you're dealing with multi-site deployments or intercompany supply chains, your workflow logic must account for these complexities. A functional consultant often designs user acceptance testing scripts that specifically target edge cases, such as currency adjustments during the approval process or shifts in tax application due to cross-border procurement. When migrating these configurations between environments using the data management workspace, meticulous attention to data entity mapping is required to ensure that your carefully crafted logic does not break upon deployment. See you in the next lecture. Welcome back. We are now entering the Sales and Order Management chapter, where we will examine the mechanics of sales order creation within Dynamics 365. Over the next few lessons, we will dissect the configuration parameters and functional dependencies that ensure our order-to-cash lifecycle remains robust. When we initiate a sales order in Dynamics 365 Supply Chain Management, we are essentially asserting a formal agreement between our legal entity and a customer. This process functions as the primary conduit for capturing customer demand, encompassing critical details such as pricing models, delivery requirements, and specific financial terms. To ensure this data is consistent, the system relies on predefined configurations that dictate default order types and customer-specific parameters. For instance, when you select a customer on the header level, the system automatically pulls site and warehouse defaults, as well as tax group associations. These initial configurations act as the foundational substrate for all downstream processing, including inventory reservation and eventual financial invoicing. The system is designed to minimize manual data entry wherever possible, leveraging templates and predefined commercial relationships to maintain integrity. Efficiency in order entry is rarely a product of manual labor, but rather the result of effectively utilizing system capabilities like item templates and sales categories. By using the copy function, users can replicate complex orders, which saves time when dealing with recurring customer requirements. However, we must integrate these operational tasks with risk management mechanisms, specifically credit limit checks. When a sales order is created, the system interfaces directly with accounts receivable to evaluate the customer's financial health before committing company resources. If an order exceeds a credit threshold, the system enforces business logic that prevents risky transactions from proceeding, thereby protecting the organization's cash flow. Such validations are essential in a controlled multi-site environment where order volume might otherwise obscure individual exposure. At the line level, we encounter a granular set of parameters that govern the actual fulfillment behavior of our inventory. Each line item contains settings for inventory reservation logic, which determines whether the system should reserve goods hard, soft, or as ordered upon creation. Furthermore, we define delivery modes and partial shipment allowances here, which dictate how the warehouse staff and the transportation teams approach the physical movement of goods. These settings are not merely informational. They act as a direct instruction set for the warehouse management modules. If we fail to configure these line-level constraints correctly, we introduce the risk of overshipping or logistical conflicts during the fulfillment cycle. Therefore, it is architecturally significant to align these line parameters with our overall inventory strategy. The configuration of these processes mandates rigorous validation of underlying framework settings, including legal entity overrides and number sequence frameworks. Security role assignments must also be audited to ensure that only authorized personnel can manually override credit limits or modify historical order data. Beyond these static settings, administrators should monitor the health of these transactions by tracking batch job execution schedules that handle periodic updates, like order confirmation or automatic posting. If the system is not tuned for performance, particularly in environments with high-frequency transactions, we may encounter bottlenecks that impact the user experience. By designing user acceptance testing scripts that specifically target edge cases, such as multi-site routing and complex workflow logic, we ensure a fault-tolerant ecosystem. Finally, we must acknowledge the deep cross-functional dependencies that exist between the sales module and the rest of the application. The creation of a sales order reverberates through the general ledger, affecting inventory valuation frameworks and triggering tax rule calculations. Additionally, if the transaction involves intercompany trade, the configuration requirements multiply, necessitating precise mapping of trading entities. Successful management of this end-to-end process requires that functional consultants understand not just the sales UI, but how these data entities migrate via the data management workspace. By maintaining this holistic view, we ensure that our ERP ecosystem remains scalable and resilient as it captures complex global demand. See you in the next lecture. Welcome back. In this lecture, we will explore the foundational mechanics of customer agreements, providing you with the necessary expertise to pass your Dynamics 365 Supply Chain Management certification. Customer agreements serve as the formal instruments that bind commercial relationships, translating long-term commitments into tangible business logic. By defining specific thresholds for volume or value, these agreements allow organizations to offer specialized pricing and discounts in exchange for guaranteed loyalty. When you configure an agreement journal, the system requires precise definitions of the commitment type, which can be categorized by product quantity, product value, product category value, or even a general value. The validity period functions as a temporal boundary, ensuring that the contractual terms remain applicable only within the pre-negotiated timeframe. Once established, the system takes on the burden of tracking fulfillment against these agreements, automatically surfacing and applying the negotiated terms to subsequent sales orders. This provides stakeholders with real-time visibility into the remaining balance of commitments, reducing the administrative overhead typically associated with manual contract management. To derive the maximum utility from this functionality, you must carefully orchestrate how agreements interact with the broader price engine. Linking an agreement to a specific trade agreement evaluation ensures that precedence rules remain intact, which is critical for prioritizing contractual pricing over standard catalog rates. This hierarchy prevents the unintentional application of generic discounts when a specialized contract is already in place. Configuration mandates a rigorous validation of underlying parameters, including potential legal entity overrides, defined number sequence frameworks, and precise security role assignments. You must also consider the execution schedules for batch jobs, as automated fulfillment tracking often relies on these background processes to update agreement status. Neglecting the synchronization of these parameters can lead to significant discrepancies between the promised terms and the actual invoicing outcomes. The architecture of these agreements does not exist in isolation. It is deeply intertwined with multiple cross-functional dependencies. General ledger postings, for instance, must account for the financial impact of specialized discounts, ensuring that your inventory valuation frameworks remain accurate throughout the agreement lifecycle. Similarly, tax rule calculations must be robust enough to handle varying price points, especially when dealing with intercompany trade configurations that may span different tax jurisdictions. Professional oversight involves regularly monitoring performance bottlenecks, often by utilizing telemetry data to ensure that complex agreement validations do not impede order processing speed. Functional consultants must design user acceptance testing scripts that specifically target edge cases, such as multi-site deployments, intricate workflow condition logic, and data entities managed via the data management workspace. By focusing on these integration points, you create a scalable and fault-tolerant ecosystem that can support complex enterprise requirements without sacrificing data integrity. I look forward to discussing order promising strategies in our next session. Welcome back, and let's examine the mechanics of available to promise calculations in Dynamics 365. In industrial systems, the capacity to provide a customer with a realistic delivery date is not merely a matter of convenience. It is a fundamental requirement of supply chain integrity. Available to promise, or ATP, represents an algorithm that interrogates your current inventory posture to determine precisely when a specific quantity of goods can be committed to a sales order. It avoids the fallacy of assuming that everything currently held in a warehouse is eligible for sale by accounting for existing reservations and future demand. By systematically processing supply and demand vectors, the system yields a dynamic numerical result that governs the ship date. If you rely on static figures, you inevitably drift into a state of inaccurate promising, which leads to back orders and eroded customer trust. A precision-engineered ATP setup ensures that the promise made to the customer is backed by actual physical logic rather than speculative anticipation. When we look deeper into the configuration of these parameters, we encounter the necessity of defined time fences. These boundaries serve as a scope for the algorithm, constraining how far into the future the system looks for replenishment or demand signals. A forward time fence determines how deep into the timeline we are willing to promise goods, while the backward time fence allows the system to analyze past demand in specific scenarios. Beyond these temporal bounds, we must define issue margins and receipt margins. These margins function as buffers against the inherent volatility of supply chain operations, effectively creating a safety hedge to accommodate late vendor deliveries or unexpected spikes in demand. Without these margins, the system operates with zero tolerance, which is rarely a sustainable strategy for complex manufacturing or distribution environments where uncertainty is a constant. The actual calculation is subtractive in nature and relies on a clear view of your operational reality across multiple dimensions. The system takes the current on-hand inventory as the starting point and subtracts the quantities that are already allocated through reservations or open demand. Simultaneously, it adds verified incoming supply, such as purchase orders or production orders that are expected to be received within the defined time frame. The result of this computation is the quantity that is genuinely available to be promised against a new requirement. If this result is negative, the system knows that it cannot fulfill the request at the current moment and must project a future date based on expected arrivals. This process is fully automated, removing the need for manual calculations that are inherently prone to human error. However, configuring the algorithm is only the technical foundation upon which you build your business process. You must ensure that the legal entity overrides and number sequence frameworks provide a consistent environment for the calculation to execute. Security roles must be carefully audited to ensure that only authorized personnel can manually override these automated dates, as an arbitrary change can invalidate the entire supply chain logic. Furthermore, the ATP process does not exist in a vacuum. It is deeply intertwined with your general ledger postings and inventory valuation methods. If your inventory costs are not calculated correctly, the financial impact of your promising strategy will not reflect your actual margin profile. You should treat the ATP engine as a critical component of your larger enterprise resource planning ecosystem, where data integrity is the prerequisite for reliable output. As we transition into the implementation phase, functional consultants must account for the complexities of multi-site deployments. A warehouse in one location may possess the inventory, but transferring it to a different site introduces latency that a simple ATP calculation might ignore if not properly configured. Data management becomes equally important when migrating your existing item structures and workflow logic into the system. You need to validate that your test scripts cover edge cases, such as what happens when a purchase order is partially received or when a sales order is canceled after the ATP date has been calculated. By utilizing telemetry data, you can observe performance at scale and identify bottlenecks that might be slowing down your promise estimations. This analytical approach transforms your system from a static database into a responsive, fault-tolerant engine that scales with your business growth. See you in the next lecture. Hello, and welcome to this deep dive into capable to promise functionality within Dynamics 365 Supply Chain Management. In this session, we will examine how CTP extends order promising logic beyond simple inventory availability to provide realistic manufacturing lead times. When a customer places an order for an item that is not currently in stock, traditional available to promise, or ATP, calculations often fail by simply reporting that the item is unavailable. Capable to promise, or CTP, changes this dynamic by integrating directly with master planning to perform a comprehensive simulation. Instead of looking only at existing physical stock, the system triggers an explosion of the bill of materials for the requested item. It then evaluates the availability of materials required for subassemblies and verifies the capacity of resources across the shop floor. This process effectively simulates the entire production lifecycle, from raw material procurement to final assembly, allowing the system to provide the customer with a calculated and accurate delivery date based on real manufacturing constraints. To make this simulation useful, you must ensure that your underlying data is exceptionally precise, as garbage in, garbage out is not merely a cliché, but a functional reality in ERP. You need highly accurate bills of materials, detailed routing definitions that reflect true cycle times, and robust capacity profiles for both your human and machine resources. If your routing times are inflated to include excessive buffer, the calculated delivery date will be unnecessarily pessimistic, potentially costing you the sale. Conversely, if your capacity profiles do not account for scheduled downtime or maintenance, the system will promise a date that your production team cannot actually meet. The system manages this by instantaneously generating planned production and purchase orders during the simulation, which act as placeholders to reserve capacity and inventory until the sales order is fully confirmed. Configuration of these features requires a structured approach that goes beyond ticking a few boxes in the parameters. You must validate your legal entity, overrides, ensure your number sequence frameworks can handle the volume of planned orders generated by simulations, and check your security role assignments. Because CTP relies on the master planning engine, the performance of your batch job execution schedules is paramount. If the planning service is delayed or lagging, the promise date provided to the customer will be based on stale data, leading to a breakdown in trust. Furthermore, cross-functional dependencies mean that your configuration touches the general ledger, inventory valuation frameworks, and even complex intercompany trade agreements. You must account for how these simulated orders interact with your existing tax calculation rules to avoid discrepancies during the invoicing phase. For those of you tasked with maintaining these systems, the responsibility extends to performance monitoring and quality assurance. You need to keep an eye on telemetry data to identify potential bottlenecks, especially when the planning engine is tasked with deep explosions for complex products. When designing your user acceptance testing, do not simply test the happy path where everything goes as expected. Focus your test scripts on edge cases, such as multi-site deployments, where inventory might be available in one warehouse, but manufacturing capacity is locked in another. Use the data management workspace to import and export your migration templates, and verify that your workflow condition logic correctly handles scenarios where CTP failsafes are triggered. Achieving a truly scalable, fault-tolerant ecosystem requires that you treat these configurations with the same rigor you apply to your most sensitive financial postings. I look forward to seeing you in our next session where we will continue building our configuration strategy. Welcome back. In this session, we examine the mechanics of delivery schedules within Dynamics 365 Supply Chain Management to manage complex fulfillment requirements. Delivery schedules provide a structured mechanism to break down a primary sales or purchase order line into multiple segments without losing the integrity of the original transaction. From a functional perspective, you are essentially creating a child-parent relationship where the main line serves as a header for quantity, while individual delivery lines track specific date requirements and shipping quantities. When you enable a delivery schedule, the system automatically shifts the primary line into a read-only mode regarding quantity, ensuring that any modifications happen at the schedule level to preserve order consistency. This is particularly useful when dealing with long-term procurement arrangements or customers who require staggered delivery of high-volume orders to match their own production intake. By decoupling the delivery dates from the single order line, you reduce the administrative overhead of maintaining multiple separate purchase orders for the same supplier deal. It acts as a clear point of control where document management stays centralized while warehouse execution remains granular and responsive to specific site demands. The engine behind this functionality relies on the synchronization between the sales order line and master planning, which requires careful parameter tuning to avoid common pitfalls. When a schedule is created, each line represents a unique delivery requirement, and if configured correctly, master planning sees these as individual demand signals. This allows the system to trigger replenishment, such as planned production orders or purchase orders, specifically timed to the requested delivery dates of each schedule line. If you fail to configure your coverage groups or lead times accurately, you risk the system suggesting an aggregate purchase that ignores the specific timing of the schedule, defeating the purpose of the feature. Furthermore, the pricing logic is calculated based on the total quantity of the parent line, which ensures that volume discounts remain intact regardless of how many individual deliveries are processed. You must ensure that the allocation logic, which determines how quantity changes flow from the parent to the child lines, is understood by the business users to prevent discrepancies during order amendments. Validation of the underlying ecosystem is mandatory for a stable implementation, as delivery schedules impact deeper financial and inventory modules. Because these lines influence general ledger postings and inventory valuation, you must verify that your tax rules, intercompany trade settings, and revenue recognition policies are compatible with split delivery logic. In multi-site environments, a single delivery schedule might trigger shipments from different warehouses, which adds a layer of complexity to inventory tracking and picking workflows. Administrators should keep a close eye on the performance of the data entities associated with order management, as large-scale bulk imports can often cause bottlenecks if not properly indexed. When designing your user acceptance testing scripts, it is advisable to simulate edge cases, such as canceling a partial shipment or modifying a delivery date after a picking list has already been generated. These scenarios often reveal weaknesses in workflow condition logic or manual data entry errors that could disrupt downstream warehouse processing or financial reconciliation at the end of a fiscal period. I will see you in the next lecture. Welcome back. In this lesson, we will examine the orchestration of the order-to-cash lifecycle within Dynamics 365, focusing on how system configurations govern the movement from initial quotation to final financial settlement. The order-to-cash process is fundamentally a state machine that necessitates strict adherence to business rules, starting long before a physical item leaves the warehouse. When we configure a sales quotation, we are not just entering data. We are establishing a binding agreement that must undergo specific validation steps, such as credit limit checks and authorization hierarchies. If a customer exceeds their allocated credit, the system must trigger an override workflow that requires a specific level of management authorization before the order can transition into a confirmed status. This creates a transparent audit trail, ensuring that every financial risk is accounted for before the commitment to sell is finalized. We must look at these workflow nodes as defensive programming constructs that prevent invalid entities from progressing through the system. Each node in the workflow designer serves as a gatekeeper that ensures data integrity and operational compliance across the organization. Once the sales order is confirmed, the system shifts its focus toward fulfillment, which is where the integration between the sales and warehouse modules becomes critical. The trigger for this transition typically involves wave processing, which aggregates specific order lines into tasks for the warehouse team to pick, pack, and eventually ship. From a system perspective, it is imperative that the configuration of these outbound processes aligns with the physical reality of your inventory handling. When the warehouse confirms a shipment, this action serves as the catalyst for the generation of both the packing slip and the advanced shipping notice, or ASN. These documents translate the physical movement of inventory into a digital acknowledgement that the company has fulfilled its obligation. If the shipping confirmation logic is not synchronized with your inventory tracking dimensions, you will almost certainly encounter variance issues in your ledgers. The final stage of the workflow involves the accounts receivable module, where the focus moves from logistics to ensuring that the cash collection process is frictionless. Generating a customer invoice is straightforward, but the underlying configuration needs to account for complex scenarios like multi-currency transactions, tax rule applications, and cross-functional dependencies with the general ledger. As soon as the invoice is posted, the system begins calculating aging parameters, which effectively dictates the strategy for dunning letters or automated collection reminders. You must ensure that the number sequence frameworks and the batch job schedules are robust enough to handle the volume and frequency of these financial operations. If a batch job that clears transaction status fails, it can create a silent bottleneck that masks true customer exposure, leading to inaccurate financial reporting. Functional consultants often view these workflows as simple sequences of events, but they are architecturally demanding when deployed across multi-site environments. When we introduce elements like intercompany trade, the complexity of the order-to-cash cycle increases substantially, requiring a deep understanding of inventory valuation methods and the specific data entities involved in migration. During user acceptance testing, you should prioritize edge cases, such as partial shipments or returns, to verify that your workflow condition logic handles unexpected interruptions gracefully. The goal is to design a system that is not only functional, but also scalable and fault-tolerant. By monitoring performance telemetry, administrators can identify exactly where a process hangs, whether that is due to poor database indexing on transaction tables or inadequately tuned batch execution parameters. Consistently reviewing your configuration parameters ensures that the enterprise resource planning ecosystem remains a reliable source of truth rather than a system prone to operational drift. We will continue our exploration of these integrated processes in the next segment. Welcome to this chapter on mobile device configuration, where we examine how to orchestrate the warehouse management mobile app interface for optimal worker productivity. We will focus on the technical mechanics of defining menus, activity codes, and the state-aware workflows that underpin efficient warehouse operations. In the ecosystem of Dynamics 365 supply chain management, the mobile device interface acts as the primary data collection and execution layer for warehouse personnel. When you configure the mobile device, you are essentially translating abstract business processes into a series of guided, granular tasks that a user performs on a handheld scanner. The architecture relies on the concept of menu items, which encapsulate a specific activity, such as a purchase order receipt, a stock count, or a picking operation. Each menu item requires you to define a specific activity code that aligns with the system's internal work creation logic. By controlling the display settings, you ensure that the text and input fields occupy the device screen in a way that minimizes cognitive load for the worker, which is vital in high-velocity warehouse environments. Organization is the next logical step, as you must aggregate these individual menu items into a hierarchical menu structure. This hierarchy dictates the navigation experience for the end user, often following physical locations or specific job roles within the warehouse layout to reduce travel time and errors. Beyond the visual structure, you must address the administrative side of worker setup, which binds physical users to their default warehouses and specific security credentials. It is important to remember that these authentication settings serve as the foundation for the security framework, ensuring that users only interact with data pertinent to their legal entity and operational domain. When managing multi-site deployments, these defaults act as the baseline, though they can often be overridden to allow flexibility in how workers navigate between zones. One of the more sophisticated features in modern warehouse configuration is the concept of detours. A detour allows a worker to suspend a primary task, like picking items for a sales order, to execute an ancillary task, such as an ad hoc cycle count or a container split. Upon completion of the subtask, the worker is intuitively returned to the point of origin in their original workflow without experiencing data loss or context switching friction. Implementing these requires a precise understanding of the work templating engine, as the system must effectively pause the state of the initial transaction while maintaining the integrity of the database locks. This functionality represents a departure from linear process execution and toward a more dynamic, user-centered approach to warehouse operations. Configuring these systems is rarely an isolated activity, as mobile device logic is deeply intertwined with the broader financial and inventory framework in Dynamics 365. For instance, the mobile interface must respect the existing number sequence frameworks and security roles that satisfy compliance and audit requirements. When a worker completes a put-away task, the resulting entry triggers specific general ledger postings and potentially updates inventory valuation, which may be influenced by tax rule calculations or intercompany trade settings. Consequently, you cannot treat the mobile configuration as a purely aesthetic or UI-based task. It is a manifestation of the entire supply chain logic. Failure to validate these dependencies often results in execution errors that are difficult to debug in a live production environment. To ensure the success of your implementation, you must incorporate rigorous testing strategies that treat mobile device logs as rich data sources. Functional consultants should develop user acceptance testing scripts that specifically target edge cases, such as how the mobile app behaves when a warehouse worker is forced to change an item's tracking dimension mid-task. Furthermore, you should leverage the data management workspace to migrate your configurations across environments, utilizing data entity templates to ensure consistency in performance and logic. Finally, once the system is active, you must continuously monitor the telemetry data generated by these handheld interactions. This monitoring allows you to identify performance bottlenecks, such as slow network handshakes or excessive work processing time, which are critical inputs for optimizing a scalable and fault-tolerant warehouse ecosystem. See you in the next lecture. Welcome back. In this lesson, we will focus on configuring location directives to automate warehouse movement decisions within Dynamics 365 supply chain management. Location directives are the backbone of your warehouse logic, acting as the decision engine that determines where the system directs inventory operations. Think of these as a series of if-then statements that the system evaluates whenever a movement, pick, or put activity is initiated. You begin by defining the work order type, such as sales orders, purchase orders, or raw material picking, which scope the directive to specific business processes. Within the header, you establish a sequence number that dictates the order in which the engine evaluates these rules. If the first directive does not meet the specified criteria, the engine moves to the next one, allowing for layered and granular control over your storage strategy. It is essential to understand that without a valid directive for a given order type, the warehouse system will fail to process the transaction, leading to operational bottlenecks. The heart of a location directive lies in the sequence of directive lines, which allow you to refine operational boundaries based on physical inventory characteristics. For instance, you might create lines based on quantity ranges, effectively separating pallet-level picking from piece-level picking to optimize efficiency. Once the logic finds a matching quantity, it proceeds to the action lines, where the actual location selection happens. Here, you define specific queries that filter by location profile, zone, or even specific warehouse identifiers. If you define a zone for bulk storage, the action query ensures the system only looks for bins within that physical grouping. This allows you to separate high-velocity items into picking zones while relegating slower inventory to deep storage bins. Strategies are the parameters you apply to these action lines to further influence behavior, such as using the empty location with no incoming work strategy. This specific strategy is incredibly useful for put-away operations, as it prevents the system from placing goods into bins that are already reserved for other pending tasks. Conversely, a consolidation strategy attempts to place items into bins where the same product is already present, which maximizes space utilization and inventory density. When configuring these, you must consider the underlying physical layout, ensuring that your storage capacity remains accurate. If your configuration includes incorrect location profiles, the directive might suggest an invalid bin, resulting in failed work execution. You are essentially codifying your warehouse layout best practices into the system so that the average user does not need to manually decide where to store goods. Beyond the technical setup of lines and actions, you must maintain a consistent administrative framework to guarantee system integrity. This involves verifying that your number sequences and legal entity overrides are consistent across multi-site deployments to avoid cross-process errors. Furthermore, the security role assignments must be carefully managed to ensure that only authorized personnel can alter the directive logic, which could otherwise lead to erroneous warehouse movements. You should also consider how these directives interact with general ledger postings and inventory valuation methods, as the physical destination of goods can impact how costs are tracked in your accounting modules. It is also good practice to schedule batch jobs for warehouse tasks to ensure that the engine has sufficient resources to process complex queries during peak hours without degrading performance. Finally, you must validate these configurations using user acceptance testing, particularly when dealing with edge cases or unconventional picking patterns. Even if the theory seems sound, data entity migration often introduces unexpected variables that can conflict with your established query logic. Use the data management workspace to test your directives in a sandbox environment before migrating them to production. Monitor your system for performance drops that might indicate overly complex queries, as excessive nesting in your filter logic can increase processing time. By keeping your location directive setup clean, logical, and thoroughly documented, you create a scalable foundation that supports the growth and adaptability of your enterprise resource planning ecosystem. You should always strive to simplify your rule sets whenever possible to make troubleshooting easier and to keep the daily warehouse operations running efficiently. See you in the next lecture. Welcome back to the course. In this chapter, we explore how work templates define the sequence of pick and put operations within the Dynamics 365 Supply Chain Management Warehouse module to ensure efficient task execution. When we talk about work templates, we are essentially defining the blueprint for how warehouse tasks are orchestrated. At its core, a work template dictates the mandatory sequence of actions that a worker must perform on the mobile device, such as picking items from a staging location and putting them into a bay door. You must define a work order type, which acts as the foundation of the template, such as sales orders, purchase orders, or transfer issues. The system evaluates these templates based on query criteria, which allows you to apply specific templates conditionally based on warehouse locations, item groups, or even specific customer tiers. If you do not define your query correctly, the system might default to the first template it finds, which can lead to inefficient task flow or errors in warehouse execution. Precision in these queries is not just a preference, it is a requirement for maintaining an orderly and predictable warehouse environment. Building on the foundation of the template, we often need to manage how large orders are processed to optimize throughput. Work splitting logic serves this purpose, allowing you to fracture massive orders into smaller, more manageable blocks based on volume, weight, or specific warehouse zones. By fragmenting these tasks, you can ensure that multiple warehouse workers can tackle a single large order simultaneously without physical congestion in the aisles. Furthermore, the concept of work classes acts as a critical link between your work templates and the mobile device menu items. By assigning a work class to a template and matching it within the menu item setup, you effectively enforce security and operational boundaries. This mechanism ensures that a worker directed to perform a replenishment task does not inadvertently start a picking operation for a sales order. Configuration of these templates rarely happens in a vacuum, as it necessitates rigorous validation of several underlying system parameters. You must consider legal entity overrides and ensure that your number sequence frameworks are robust enough to handle the generation of unique work IDs. Security role assignments must be audited to ensure that warehouse personnel have access only to the menu items that correspond to their specific work classes. Beyond the immediate configuration, you must keep in mind that these templates are deeply intertwined with broader financial and inventory processes. Changes in your work templates can impact general ledger postings, especially when inventory shifts or adjustments occur during the put operations. Moreover, you need to verify how your inventory valuation methods and intercompany trade configurations interact with the inventory movements triggered by these templates. For those of you acting as functional consultants, the design of user acceptance testing scripts is a vital part of the implementation lifecycle. You should specifically target edge cases, such as multi-site deployments, where inventory might move across different logical warehouses, which can complicate the template logic. When testing, place a heavy emphasis on workflow condition logic to ensure that the system handles exceptions, such as items being short-picked or damaged, without stalling the entire process. Furthermore, when migrating data between environments via the data management workspace, ensure that your templates are included in your entity sequences to maintain consistency across your development, test, and production instances. Administrators should also look toward telemetry data to monitor for performance bottlenecks, as poorly structured work templates are a common cause of latency in high-volume warehouse operations. Maintaining a clean, simple, and logical template structure is the best way to safeguard against these issues. I will see you in the next lecture. Welcome back to our exploration of the Warehouse Management module, where we are focusing on optimizing outbound logistics. In this lesson, we will examine the intricacies of wave processing configuration within Dynamics 365 Supply Chain Management. Wave processing serves as the engine that aggregates individual outbound order lines into consolidated batches to streamline the movement of goods within your facility. By grouping shipments based on criteria such as shipping method, delivery time, or item characteristics, you significantly reduce the travel time for warehouse operatives and improve overall picking throughput. The primary mechanism for this consolidation is the wave template, which defines the rules under which a shipment or order volume is processed. When you configure these templates, you must carefully select the wave template type, which dictates whether you are managing shipping, production, or replenishment waves. This initial classification governs the subsequent behavior of the system, including how work templates are assigned and how inventory is allocated to meet order requirements. If your operational volume is high, you should strongly consider enabling the automated processing features available within these templates to remove human friction from the process. To achieve a truly lean warehouse environment, you must leverage the automation parameters embedded within the wave template itself. Specifically, you can define settings to automatically create, process, and release the wave as soon as the associated order is released to the warehouse. This automation eliminates manual intervention for standard high-volume shipments, allowing your staff to focus on solving exceptions rather than clicking through administrative screens. However, automation must be balanced with the integration of wave step codes, which are essential for driving complex back-end logic. Wave step codes act as triggers for specific actions, such as automatically generating replenishment work to move stock from bulk storage to forward-picking locations before the main wave execution occurs. By defining these steps explicitly, you ensure that the system verifies inventory availability and triggers the necessary prerequisite tasks without manual oversight, thereby maintaining a consistent flow of stock to the picking phase. Advanced configuration allows you to implement sophisticated sorting and grouping algorithms that further refine the efficiency of your warehouse operations. Through the configuration of wave templates, you can determine how the system groups lines for identical items across multiple disparate orders. This consolidation is powerful because it allows a single pick run to satisfy the requirements for multiple customers at once, drastically reducing the total distance an operative must walk. Beyond mere sorting, you must consider the structural requirements such as legal entity overrides, number sequence frameworks, and the necessary security role assignments that govern who has the authority to release waves. Furthermore, you must ensure that your background batch job execution schedules are tuned to handle the expected load, as wave processing can be a resource-intensive operation in large-scale multi-site deployments. Neglecting these infrastructure settings can lead to performance bottlenecks, even if your functional logic for wave grouping is perfectly sound. Implementation of wave processing is rarely an isolated activity, as it creates strong, cross-functional dependencies across your enterprise. The acts of allocating inventory and processing waves inevitably touch upon general ledger postings, as the system must track inventory valuation shifts and potentially trigger tax calculations if your intercompany trade configurations are active. You should approach the design of these processes with a mindset toward resilience, utilizing telemetry data to monitor how your wave templates perform under peak load conditions. As a functional consultant, your responsibility extends to crafting user acceptance testing scripts that specifically target edge cases, such as partial allocations, inventory shortages, or complex workflow conditions. By validating these scenarios through data entity migration templates in the data management workspace, you help guarantee that your ERP environment remains scalable and fault-tolerant in the face of varying business demands. I look forward to our next discussion on warehouse workflows. Welcome back. In this lesson, we explore picking and packing workflows within Dynamics 365 Supply Chain Management to master the movement of goods from inventory to outbound logistics. The foundation of any robust warehouse operation rests on how effectively you manage the transition from inventory locations to the shipping dock. When we talk about picking, we are essentially defining the execution logic that instructs warehouse workers on where to go, what to pick, and how to verify their actions through mobile devices. You must consider the configuration of work templates and location directives, as these define the pathing and the granularity of the tasks generated for your staff. If you fail to align these templates with your specific warehouse layout, you will undoubtedly face inefficiencies that manifest as increased travel time or improperly consolidated picks. It is vital to recognize that the system does not merely suggest a path. It enforces a strict sequence of events that must be validated at every step. By utilizing mobile device menus, you ensure that the physical act of picking matches the digital reality within the system, thereby maintaining inventory integrity throughout the entire process. Cluster picking represents a specialized subset of these workflows, intended to optimize the fulfillment of multiple sales orders simultaneously using a single cart or pallet. When you configure a cluster profile, you essentially assign positions on a physical piece of equipment to specific orders, allowing a worker to pick items for several customers in one trip. This approach is highly effective for high-volume environments where order density is high, but it necessitates careful control over configuration to prevent cross-contamination of goods. You must define the cluster profile to determine whether the user is prompted for a position assignment or if the system automatically assumes a sequence. Think of this as a way to reduce movement overhead, provided that your physical hardware accurately mirrors the logic you have implemented in the software. If you misconfigure the capacity or the validation rules, you risk picking errors that are significantly harder to rectify once the goods have reached the staging area. Once the picks are completed, the focus shifts to the packing station, which is where the physical containerization process happens. Configuring packing stations involves establishing container types, which define the physical dimensions and weight limits that the system uses to calculate volume occupancy. You will also encounter closure profiles, which dictate the behavior of the system when a container is considered finished, including whether to print labels or trigger specific weight verification tasks. Integration with shipping carrier software is not an optional afterthought. It is a critical component that finalizes the parcel generation by calculating the necessary manifesting data. By automating the capture of these dimensions and integrating directly with carrier APIs, you minimize the risk of human error and significantly reduce congestion at the shipping dock. The objective here is to design a workflow where data flows seamlessly from the packing bench to the carrier, ensuring that compliance labels are generated with absolute precision. Implementing these workflows is never solely an exercise in UI configuration, as the system relies on a complex web of underlying parameters. You must pay close attention to legal entity overrides and number sequence frameworks, as these ensure that your document numbering remains consistent across complex, multi-site deployments. Security role assignments act as a guardrail, ensuring that only users with the appropriate permissions can initiate or override a packing workflow or adjust inventory quantities. Furthermore, you cannot ignore the cross-functional dependencies that these workflows impose on other parts of the application. Inventory valuation, general ledger postings, and tax rule calculations are all deeply intertwined with the completion of a picking or packing task. If a sales order requires specific tax handling or triggers a ledger posting, the underlying configuration must support these events without interrupting the operational flow on the warehouse floor. Successful administration of these processes requires a proactive stance on monitoring and performance optimization. You should leverage telemetry data to identify bottlenecks in your workflow execution, particularly in high-throughput environments where warehouse activity is constant. Functional consultants should approach this by designing user acceptance testing scripts that specifically target edge cases, such as partial picks, damaged inventory, or adjustments occurring in the middle of a wave. Data management must also be prioritized using templates to ensure that your workflow conditions are consistently applied across your staging and production environments. By maintaining a clean architecture for your data entities and workflow logic, you build a scalable ecosystem that remains resilient in the face of changing business requirements. Ultimately, the quality of your outbound logistics is directly proportional to the rigor with which you validate these interlinked parameters and monitor the system performance under load. I will see you in the next session. Welcome to the chapter on optimizing inventory flow, where we will explore cross-docking and Dynamics 365 supply chain management. By the end of this module, you will have mastered the configurations necessary to accelerate throughput and minimize storage overhead. Cross-docking is fundamentally an architectural strategy designed to improve the velocity of goods through your warehouse by reducing unnecessary touchpoints. Instead of following the traditional path of put away into bulk storage, followed by a subsequent pick, cross-docking allows you to route an inbound receipt directly toward an outbound staging location. This represents a significant optimization for high turnover products, where storage duration is not only uneconomical, but physically redundant. When you implement this correctly, you effectively turn your warehouse into a transit hub rather than a traditional storage facility. This requires a shift in how you perceive the standard inventory lifecycle because the system must recognize and prioritize a match between incoming supply and existing outbound demand before the items ever hit a rack. Achieving this balance requires a disciplined approach to the underlying warehouse management parameters that govern how we move goods. To implement this functionality, you must carefully navigate the setup of location directives and work templates to ensure the system behaves predictably. Planned cross-docking operates by leveraging the output of master planning to preemptively link incoming purchase orders with specific outbound sales demand. When you define a cross-docking template, you specify the criteria for items and quantities that should bypass the standard put-away logic. You must also configure a designated cross-docking location, which acts as a temporary holding area for these diverted goods. Without this precise configuration, the warehouse management system will default to its standard put-away routines. Remember that these configurations are not isolated. They interact directly with your broader inventory strategy, including item group settings and warehouse site structures. Beyond the planned approach, opportunistic cross-docking offers a more dynamic method to handle back orders at the moment of receipt. This methodology evaluates current demand in real time as items are scanned at the inbound dock, allowing the system to intercept incoming inventory that can immediately satisfy an existing open order. This requires a robust setup where the system is permitted to perform these interceptions without manual intervention. provided the criteria defined in your mobile device menu items and work templates are met. You need to ensure that the cross-docking template is enabled for the warehouse and that the specific item-product combinations are correctly associated. If the logic fails to trigger, it is often due to a mismatch in the item warehouse mapping or a failure to properly define the replenishment threshold. Because this process is highly automated, your validation scripts must account for these edge cases to avoid inventory mismatches or stalled warehouse tasks. Configuration of these features is not a task you can perform in a vacuum, as it carries deep dependencies into the legal entity and master planning frameworks. You must ensure that your number sequences and security rules are correctly aligned to allow warehouse management to generate the necessary work headers and line items. Furthermore, cross-docking integrates with financial processes such as inventory valuation and general ledger postings, meaning any error here could impact your financial reporting. If you use intercompany trade or multi-site deployments, the complexity increases, necessitating a clear definition of your cross-docking hubs and transfer policies. You should regularly review telemetry data to identify where the configuration might be creating bottlenecks rather than clearing them. A successful implementation depends on this holistic view where data entity migration and user acceptance testing provide the safety rails for your enterprise resource planning environment. See you in the next lesson. Welcome back. In this chapter, we explore the complexities of the transportation management system, specifically focusing on how rating and routing principles dictate efficient shipment execution for your supply chain. Effective transportation management within Dynamics 365 requires a precise understanding of how rating engines translate physical product characteristics into financial costs. When we evaluate rating, we are essentially building a mathematical model that reconciles weight, volume, and distance against specific carrier tariff structures. A rate master acts as the central repository where this logic resides, pulling data from postal code mapping and mileage engines to determine the base cost of moving inventory. However, the calculation is rarely as simple as distance multiplied by weight, because you must also account for accessorial charges that fluctuate based on service requirements. These surcharges might range from fuel adjustments to specialized handling fees for hazardous materials or specific delivery windows. As systems administrators, you must ensure that these parameters are validated through rigorous testing, as any miscalculation here ripples directly into your general ledger and inventory valuation models. Routing guides provide the necessary framework to navigate the logistical path from origin to destination by evaluating transit times and carrier capabilities. Unlike the purely quantitative nature of rating, routing involves a qualitative assessment of service level agreements and operational constraints involving LTL, FTL, or parcel delivery modes. The routing engine must verify that the selected carrier possesses the capacity to handle specific shipment volumes while maintaining the required delivery schedule. This often involves establishing hub networks where regional carriers consolidate freight before long-haul movement, which complicates the configuration significantly. You must meticulously map out operational constraints, as this prevents the system from suggesting suboptimal or physically impossible routes for your shipments. Furthermore, these guides function in tandem with workflow conditions, ensuring that the selected route aligns with organizational policies and commercial requirements. The technical backend of these configurations demands absolute consistency in the underlying framework, particularly regarding legal entity overrides and global number sequences. When you move beyond a single site implementation, your routing logic often encounters conflicting regulatory or tax rule requirements that must be handled via sophisticated condition logic. Administrators typically rely on batch job execution schedules to process these rating and routing requests asynchronously, which requires careful monitoring to prevent performance bottlenecks. If the telemetry data indicates that your rate lookups are timing out or that the routing engine is failing to produce valid transit paths, you must investigate the integrity of the data entity migration templates you utilize during deployment. Functional consultants often mitigate these risks by designing user acceptance testing scripts that specifically target edge cases, such as extreme weight variability or complex multi-site delivery scenarios. Integrating these concepts into the broader enterprise resource planning ecosystem necessitates tight coordination with your financial and inventory modules. Because freight costs often capitalize into the landed cost of inventory, Any error in the initial rate calculation manifests as an inaccuracy in inventory valuation. Intercompany trade configurations further complicate this, as you may need to apply different rate masters depending on the legal entity involved in the transfer of goods. Tax rule calculations must be synchronized with the transportation management modules to ensure that duty and tariff assessments remain compliant regardless of the transit path selected. Maintaining a scalable configuration requires that you treat rating and routing not as isolated features, but as active participants in your overall procure-to-pay and order-to-cash workflows. Constant vigilance regarding the relationship between these transportation policies and the general ledger is the hallmark of a robust Dynamics 365 implementation. See you in the next session. Welcome to this chapter regarding the intricacies of transportation load building within Dynamics 365 supply chain management. We will examine how to configure the workbench to aggregate shipments into optimal transport loads effectively. Load building represents a systematic effort to maximize trailer space utilization while simultaneously minimizing total freight expenditure across your logistics network. When you begin configuring this in Dynamics 365, you must first recognize that the system relies heavily on the definition of volumetric and weight capacity profiles. These profiles act as the constraints for your heuristic algorithms, ensuring that the software understands the physical limitations of the equipment being loaded. Without accurate definition of these profiles, the system cannot intelligently propose containerization strategies during the wave processing phase of your operations. You are essentially teaching the system how to balance weight distribution against vertical stacking rules to prevent damage and ensure safe transport. This requires a disciplined approach to master data management, particularly regarding pallet dimensions and product unit of measure conversions. The load building workbench serves as the primary gateway for dispatchers to manage these assignments either manually or through automated execution strategies. To move beyond manual assignment, you must configure load building strategies that define the criteria for grouping sales order lines into loads. These strategies utilize specific sequence strategies, which dictate whether the system should look for the most packed load first or perhaps prioritize the clearing of certain warehouse zones. You will find that these strategies are highly configurable, allowing you to incorporate 3D spatial constraints if you have defined the physical dimensions of your storage and transport units properly. Keep in mind that the effectiveness of these strategies is entirely dependent on the quality of the data feeding into them. If your inventory items lack proper physical dimensions, or if your container types are broadly defined, the resulting load proposals will likely require significant manual intervention, defeating the purpose of automation. Configuration involves rigorous validation of several underlying parameters that bridge the gap between pure logistics and enterprise-wide financial reporting. You must navigate the legal entity overrides to ensure that your transport configurations align with specific regional requirements or business unit policies. Number sequence frameworks for loads and shipments must be established early to ensure auditability across the transactional lifecycle. Furthermore, security rule assignments are paramount, as the ability to finalize and release loads carries significant downstream impacts on warehouse operations and general ledger postings. You should also pay close attention to batch job execution schedules, as high-volume environments often require these load-building processes to run outside of peak warehouse activity to prevent system performance degradation. These settings are not global toggles, but rather discrete configurations that interact with the broader Dynamics 365 ecosystem. Cross-functional dependencies often represent the most challenging aspect of long-term maintenance for these configurations. Your load-building setup interweaves with inventory valuation frameworks, particularly when freight costs are assigned to specific loads and later allocated back to inventory cost prices. You must also consider tax rule calculations, which vary depending on the shipment destination and the specifics of the transport contract established with your carriers. Intercompany trade configurations add another layer of complexity, demanding that load-building strategies remain consistent across both selling and shipping legal entities. If you are operating in a multi-site deployment, your load-building logic must accommodate the varying physical constraints of each location. Functional consultants need to develop comprehensive testing scripts that target these edge cases to ensure that your logistics workflows remain robust under diverse operating conditions. Administrators must adopt a mindset of continuous improvement by monitoring performance bottlenecks through the provided telemetry data. Identifying why a certain load strategy is underperforming requires observing the relationship between sales order line priority and the availability of dock door resources. Logic errors often manifest during wave processing when the load building attempt conflicts with existing warehouse work templates. By utilizing the data management workspace, you can create migration templates that help standardize these configurations as your organization expands into new territories or warehouses. A well-designed load-building ecosystem is inherently fault-tolerant, providing dispatchers with enough visibility to intervene if the automated system generates an impractical proposal. Ultimately, your goal is to create a seamless sync between outbound waves and load assignments to minimize the transit time from your warehouse floor to the final customer delivery point. See you in the next lecture. Welcome back. Today, we are transitioning into the freight reconciliation features within the Transportation Management module. We will discuss how to configure the auditing and settlement mechanisms required to handle carrier invoices effectively. Freight reconciliation is essentially a gatekeeping mechanism that ensures the integrity of your transportation spend by matching the estimated costs calculated during the planning phase against the actual charges submitted by your carriers. When you configure this, you are effectively creating a bridge between the Transportation Management module and the Accounts Payable module. The configuration begins with defining the freight bill types, which act as the template for how incoming invoices are parsed and interpreted by the system. You must establish matching audit criteria that define exactly what the system should look for when comparing a freight bill to a carrier invoice. If the invoice amounts align perfectly with your internal estimations or fall within a predefined tolerance threshold, the system can automatically approve the charges without requiring human intervention. This automation is vital for maintaining throughput in high-volume logistics environments where manual verification of every line item would create an unsustainable bottleneck. Achieving this level of automation requires a disciplined approach to the underlying parameters that govern the matching process. You need to focus on the freight reconciliation setup form, where you map the freight bill line details to the corresponding vendor invoice fields. It is critical to configure your tolerance settings correctly, as these define the financial leeway you allow for discrepancies such as carrier rounding differences or minor weight adjustments. Think of these tolerances as risk management parameters. Setting them too loosely invites potential financial leakage, while setting them too strictly results in an excessive number of exceptions that negate the benefits of automation. Once the matching rules and tolerances are established, the system creates the freight bill journals, which are then used to process the actual vendor invoices and accounts payable. This integration ensures that the financial data remains consistent across your general ledger, providing visibility into your exact transportation costs per load, shipment, or individual order. Managing exceptions is an inevitable part of the freight lifecycle, and your configuration must account for how the system behaves when an invoice fails the matching process. A robust dispute management workflow allows your transportation planners to intervene when a carrier invoice deviates significantly from the planned rate. Within this workflow, you can categorize the dispute, assign it to a specific user, and track the communication history with the carrier until a resolution is reached. If you determine that the carrier's charge is correct, you can adjust the freight bill to align with the invoice, which subsequently triggers an update to the financial postings to reflect the true cost. Conversely, if you successfully dispute the charge and the carrier provides a corrected invoice, the system should allow you to rerun the matching process. This iterative approach to auditing ensures that you are only paying for services actually rendered at the rates that were previously negotiated and agreed upon. Beyond the functional setup, you must consider the technical dependencies that underpin the freight reconciliation framework. You are dealing with a complex interplay between legal entity overrides and number sequence frameworks that ensure each audit trail is unique and traceable for internal or external auditors. Security role assignments must be carefully crafted to ensure that only authorized personnel can approve invoices or modify tolerance thresholds, thereby maintaining a clear segregation of duties. You will often find the need to schedule batch jobs for automated processing, which requires a deep understanding of the execution windows and the load it places on your Dynamics 365 environment. Furthermore, ensure that your data entity migration templates are aligned with your configuration, as you may eventually need to replicate these settings across multi-site deployments to maintain consistency in your supply chain operations. Cross-functional dependencies often involve the interaction between your freight costs and your inventory valuation methods. When you account for freight, you are essentially increasing the cost of goods sold or adding to the landing cost of your inventory, depending on your accounting policies. If your organization uses intercompany trade, the reconciliation process becomes even more nuanced as you must ensure that cross-entity freight charges are handled correctly without creating imbalances in the general ledger. Your tax rule configurations also play a major role here, as freight services are frequently subject to specific tax jurisdictions that must be validated during the invoice settlement process. By treating freight reconciliation as a systemic component rather than a siloed task, you provide the architects and stakeholders of your ERP system with a predictable, scalable, and audit-ready transportation management ecosystem. See you in the next lecture. Welcome to this session on the intricacies of carrier setup and management within the transportation module. We will explore how to model external logistics entities and link them to the system's operational requirements. When we approach the task of configuring carriers, we are essentially defining the external partners that provide the physical movement of our inventory. From a system design perspective, this begins with the creation of the carrier record itself, which acts as the primary entity for all subsequent transportation logic. You must first establish the shipping carrier, which serves as the organizational hub, and then categorize these entities into carrier groups to enable simplified reporting and management. Within these entities, you define specific services that represent the actual modes of transit, such as next-day air, ground freight, or specialized cold chain transport. Each of these services requires an associated service level that dictates the expected performance and time in transit constraints expected by your customers. The power of this configuration lies in its ability to abstract the physical logistics logic away from the core sales order fulfillment process, allowing the system to handle complex routing decisions automatically. Integration with external logistics partners is achieved through the configuration of connection parameters that link Dynamics 365 to the specific API endpoints provided by the carrier. This infrastructure allows for the near instantaneous transmission of data related to shipment manifesting, tracking updates, and the automated generation of shipping labels directly within the user interface. It is important to treat these integrations as sensitive external dependencies, ensuring that credentials and communication protocols are robustly managed. Because you are dealing with real-time data, you must also consider the performance impact of these network calls on your broader supply chain workflows. If an API request fails, your system must possess the capability to capture that failure state and trigger an alert or a fallback strategy to avoid halting the warehouse picking process. Reliable integration hinges on the correct mapping of EDI or XML schema requirements, which the system handles through the exchange of data entities during the manifesting step. Beyond the basic mechanics of movement, modern logistics requires precise control over the financial variables that influence the cost of shipping. Fuel surcharges are handled through dynamic tables that allow you to adjust freight rates based on fluctuating market indicators, ensuring your cost recovery strategy remains accurate. Similarly, you will encounter the need for accessorial masters, which are used to define auxiliary costs associated with specific delivery requirements like liftgate services or residential delivery premiums. These values are not merely static figures, but are integral components of the shipping rate calculation engine that computes the projected cost for a load. When you configure these elements, you are essentially setting up a pricing model that the system will evaluate alongside your contract constraints. By centralizing these costs, you provide the system with the raw data it needs to perform accurate freight reconciliation during the post-shipment stage. To ensure the longevity and reliability of your logistics setup, you must implement constant performance monitoring of your selected carriers. By leveraging the telemetry data collected by the system, you can generate metrics that quantify on-time delivery percentages and overall transit reliability. This data-driven approach is invaluable during contract negotiations, as it provides you with empirical evidence of service performance versus cost. Furthermore, every carrier configuration must survive the rigors of your internal structural standards, such as appropriate legal entity overrides and the alignment of number sequences to maintain audit-ready records. Security is not an afterthought here. You must ensure that only authorized personnel have the permissions required to modify shipping parameters, while warehouse users possess the read-only access necessary for daily execution. Regular execution of batch jobs is required to finalize these manifest operations, meaning that you must carefully schedule these tasks to avoid contention during peak shipping windows. The complexity of these setups often intersects with broader domain logic, specifically in the areas of general ledger account mapping and dynamic tax calculations. When a freight charge is applied to an order, the system must know which expense or revenue accounts to update based on your specific financial policies and inventory valuation methods. Intercompany trade configurations add another layer of complexity, as the transportation logic must account for internal product transfers where carrier selection might be dictated by intercompany agreements rather than spot market rates. A functional consultant should approach the testing of these systems by scripting for edge cases, such as partial deliveries, multi-site product sourcing, or changes in shipping address after the initial carrier selection has been made. By validating these workflows through rigorous user acceptance testing, you ensure that the logistics ecosystem acts as a stable foundation rather than a bottleneck. Managing this scale requires a deep understanding of data entity migrations, particularly when moving these configurations across your sandbox and production environments. See you in the next lecture. Welcome back. In this lesson, we will focus on the mechanics of route plans and route guides within the transportation management module. Route plans serve as the architectural backbone for complex, multi-segment transportation itineraries. When we speak of a route plan, we are defining a fixed sequence of locations, or nodes, that a shipment must traverse to arrive from an origin to a final destination. These nodes are not merely placeholders. They represent functional checkpoints, such as cross-docking facilities, regional distribution hubs, or specific customs clearance zones. By establishing these segments, you allow the system to coordinate intermodal movements involving different carriers at various stages of the transit. It is a configuration that effectively maps out the logical path of a load, ensuring that the movement of goods is predictable, repeatable, and capable of being audited. Without a well-defined route plan, the system remains blind to the logistical constraints of your international transport operations. Once you have defined your route plans, you need a mechanism to select the right one for a given load, which is where route guides come into play. A route guide acts as an intelligent router that applies conditional logic to match a load against your available route plans. You define the criteria based on parameters such as weight, dimensions, destination postal code ranges, and modes of delivery. When a shipment is evaluated, the route guide interrogates these attributes to automatically assign the optimal route plan. This automation removes the manual overhead and potential for human error inherent in choosing flight paths or trucking routes. It ensures that the shipping process adheres to specific customer delivery mandates and regional transport regulations without requiring constant intervention from logistics planners. The configuration of these elements requires rigorous attention to the underlying parameter framework. You must ensure that your number sequence frameworks are correctly established to handle the generation of route IDs and shipment identifiers across the legal entities involved. Security role assignments must be carefully scoped, as the ability to modify route plans directly affects downstream financial performance and operational efficiency. Furthermore, consider the scheduling of batch jobs responsible for processing rate engines and routing queries, as inefficient execution here can lead to significant bottlenecks. Since route planning does not exist in a vacuum, you must account for cross-functional dependencies, such as how these selections influence general ledger postings for freight costs or inventory valuation. A misconfigured route guide can inadvertently trigger incorrect tax rule calculations or disrupt intercompany trade flows if the transfer of ownership occurs at a specific node in your plan. For those acting as functional consultants, the design phase must include a robust strategy for user acceptance testing, particularly for edge cases. You should build test scenarios that account for multi-site deployments and ensure that your workflow condition logic handles unexpected transit delays or port closures gracefully. When moving configurations between environments, use the data management workspace to import and export your route setups, but always validate these against the specific constraints of the target site. Performance telemetry data is your best friend when monitoring these systems, as it provides visibility into how long routing calculations take and whether specific carriers are consistently failing to meet transit time commitments. By treating the route planning configuration as an evolving codebase, you create a fault-tolerant ecosystem capable of scaling alongside your increasing complexity of logistics. I will see you in the next lecture. Welcome back. In this lecture, we will explore the orchestration of freight movements through the transportation management workflows within Dynamics 365 Supply Chain Management. At its core, the transportation management module relies on a series of automated workflows to govern the life cycle of a shipment, from the initial rating request all the way through to the final freight invoice reconciliation. These workflows are not merely procedural tasks, but are structured systemic governance mechanisms that ensure consistency across complex logistics operations. When you define these processes, you are essentially establishing the routing logic that dictates how freight bills are approved, how disputes are handled when charges do not match expectations, and how new carriers are onboarded into your system. By utilizing the built-in workflow framework, you gain the ability to mandate specific approval hierarchies that must be satisfied before a payment can be issued to a carrier. This level of control is necessary to prevent unauthorized expenditure and to maintain an audit trail that meets standard financial compliance requirements. A significant aspect of these workflows is the implementation of automated notifications, which serve as an early warning system for transportation dispatchers. When an exception occurs, such as a load delay, a customs hold, or a sudden carrier rejection, the system must trigger an alert to the appropriate personnel immediately. This proactive approach to exception management is what prevents a minor tactical issue from cascading into a significant customer-facing service failure. By configuring these notifications correctly, you provide the necessary visibility to staff who are managing the day-to-day coordination of goods. Furthermore, this integration ensures that transportation status updates are synchronized with your sales and purchase orders, which is critical for maintaining data integrity. If a carrier updates the status of a load as in transit, that information needs to be visible to customer service representatives who rely on real-time data to answer inquiries regarding delivery timeline. Configuration of these workflows requires a disciplined approach, particularly concerning the validation of underlying system parameters. You must pay careful attention to legal entity overrides, as your transportation strategies might differ based on the specific operational laws of the entities involved, particularly in international trade scenarios. Number sequence frameworks must be clearly defined to ensure that every shipment, load, and invoice maintains a unique and trackable identifier throughout the system. Additionally, security role assignments must be scoped so that only authorized users can modify workflow conditions or bypass approvals, reducing the risk of internal error or fraud. You should also verify that your batch job execution schedules are optimized to handle the volume of data generated by your transportation operations without creating performance bottlenecks. Failure to validate these parameters, such as the timing of scheduled tasks, often leads to stale data or, worse, stalled financial processes. The complexity of these workflows is further compounded by their cross-functional dependencies, as transportation is rarely a siloed activity. General ledger postings must be correctly mapped to ensure that freight costs are properly captured against the right accounts, and inventory valuation frameworks must account for landed costs when transportation expenses are involved. Tax rule calculations are equally critical, as freight charges may be subject to different tax jurisdictions based on the origin and destination points of the shipment. In cases involving intercompany trade, you must ensure that intercompany configurations support the automated clearing of these charges between affiliated legal entities. If these linkages are not properly established during the initial design phase, you will find yourself dealing with persistent reconciliation errors that require manual intervention long after the initial setup is complete. From the consultant's perspective, success depends on your ability to monitor performance through telemetry and to test the system rigorously before go live. You should utilize the performance data provided by the application to identify where the workflow logic might be creating latency, especially in environments with high transactional volume. When designing user acceptance testing scripts, you must focus specifically on edge cases, such as partial deliveries, split shipments, or scenarios where a carrier might reject only a portion of a load. Data entity migration templates within the data management workspace are essential for ensuring that your configurations are scalable and consistent across multiple environments. By treating your workflow design as a robust, fault-tolerant configuration, you build a foundation that can withstand the demands of a complex enterprise ecosystem. A well-designed workflow system ultimately transforms transportation management from a reactive overhead into a predictable and reliable component of your broader supply chain strategy. I hope this helps you understand the intricacies of managing these workflows effectively. See you in the next lecture. Welcome to our examination of coverage groups, a foundational element in Dynamics 365 supply chain management that governs how the system perceives and reacts to supply and demand requirements. In this chapter, we will delve into the technical configuration of these groups, ensuring you understand the precise mechanics required for the upcoming certification exam. Coverage groups are the primary mechanism by which you instruct the master planning engine on how to treat specific groups of items. When you think about supply chain planning, you are essentially defining a set of heuristics for replenishment, and coverage groups provide the mathematical framework for those heuristics. By associating an item with a coverage group, you determine the coverage code, which dictates whether the system applies a simple min-max logic, a period requirement, or a more precise requirement-based approach. The requirement approach is highly transactional, creating a planned order for every demand line, whereas the period approach aggregates demand into buckets to reduce planning noise. Designing these configurations correctly necessitates a clear understanding of your organizational inventory strategy, as selecting the wrong code can lead to unnecessary stock accumulation or, worse, chronic product shortages. It is not merely a matter of technical setup. It is an exercise in resource constraint management that ripple through your entire procurement workflow. One of the most consequential configurations within these groups involves the definition of positive and negative days, which frequently serve as a point of confusion for those new to the planning engine. Positive days define the window during which existing inventory or incoming supply can satisfy a requirement, effectively telling the system to skip generating a planned order because the existing stock within that horizon is sufficient. Conversely, negative days establish a grace period for fulfilling demand with delayed supply, which acts as a buffer to prevent the system from aggressively scheduling new replenishments if a receipt is only slightly overdue. You must approach these parameters by analyzing your lead times and supplier reliability, as an improperly tuned negative days setting can either mask genuine supply failures or cause a massive spike in planned order suggestions. If you set your negative days too low, the system will panic at any slight delay, generating a flurry of planned orders that create excess inventory levels. If you set them too high, you might fail to detect a legitimate need for procurement action until it is too late to satisfy your end customers. Time fences are the final guardrails that restrict the scope of the master planning calculation, ensuring the system remains performant and focused on actionable timeframes. These fences are bifurcated into categories such as coverage, forecast, and firming, each serving a distinct purpose in the planning lifecycle. The coverage fence determines the planning horizon for which the system will generate planned orders, effectively stopping the engine from suggesting activities in the distant future where the data accuracy is naturally lower. Firming time fences are equally critical, as they prevent the master scheduler from automatically modifying planned orders that have already entered the planning phase of the warehouse or production floor. When configuring these, consider the trade-off between visibility and computational load, as excessively long time fences on a high-volume item count will inevitably lead to increased processing times during your master scheduling batch jobs. The goal is to set these fences just wide enough to cover your lead times plus a safety margin, while keeping them constrained enough to maintain a responsive planning environment. Beyond the basic parameters, you must pay strict attention to the cross-functional dependencies that influence how coverage groups behave in a live environment. Coverage groups are not isolated settings. They interact directly with your legal entity definitions in multi-site configurations, requiring careful validation of site-specific overrides to ensure that regional supply demands are met. The number sequence framework and security roles assigned to the administrative users who manage these groups are often overlooked, yet they are vital for ensuring that the planning configuration remains consistent and auditable according to enterprise standards. Furthermore, when implementing these in a production environment, you should always design your data management workspace entities to facilitate testing migration, as manual configuration carries the high risk of human error. You must think of your coverage group setup not as a static task, but as a dynamic configuration that evolves alongside your inventory valuation methods and intercompany trade policies, necessitating periodic review and adjustment. We'll move on to the next topic now. Welcome back to our exploration of master planning. In this chapter, we will discuss forecasting models configuration to establish the predictive foundation for your supply chain. Forecasting models serve as the statistical backbone for demand planning within Dynamics 365 supply chain management. By leveraging these models, organizations transition from reactive procurement to proactive inventory positioning, aligning stock levels with anticipated market behavior before actual sales orders materialize. The configuration process begins by defining item allocation keys, which effectively segment your items for forecasting purposes. These keys determine how demands are prioritized and grouped, allowing you to manage disparate product portfolios with varying degrees of statistical complexity. Establishing historical data boundaries is equally crucial, as it filters relevant past transactions to ensure that machine learning algorithms operate on clean, representative datasets. If the data window is improperly defined, the system may overfit to noise or, conversely, ignore long-term trends that remain highly relevant to future demand patterns. Integrating Azure Machine Learning elevates these baseline forecasts beyond simple linear projections by identifying complex correlations in historical data. Dynamics 365 interfaces with the Azure platform to execute these sophisticated algorithms, which then feed the calculated demand expectations back into your master plan. Once a forecast is generated, you must implement forecast reduction principles to ensure that actual sales orders correctly consume the forecast. Without these rules, the system risks double counting demand, as it would treat a sales order as additive to the already accounted for forecast, leading to inflated requirements and expensive overstocking scenarios. Furthermore, supply forecasts allow you to map anticipated production or procurement requirements, effectively balancing expected demand against your strategic supply initiatives. This alignment is vital for maintaining lean inventory levels while ensuring that material availability remains consistent with service-level agreements. Operational success in this domain mandates rigorous validation of underlying parameters that often remain obscured during initial setup. You must configure legal entity overrides to ensure that forecasting logic respects the jurisdictional nuances and fiscal requirements of specific subsidiaries. Number sequence frameworks and appropriate security role assignments are also critical to ensure that system integrity is maintained and that data is accessible only to authorized demand planners. Furthermore, the reliance on batch job execution schedules cannot be overstated. Since demand forecasting is computationally intensive, these jobs must be architected to run during off-peak hours to prevent performance degradation within the transactional environment. You should treat these parameters not as static settings, but as dynamic configurations that require periodic audits to ensure they still reflect the evolving reality of your supply chain. Beyond the dedicated forecasting module, your configuration choices possess cross-functional dependencies that permeate the broader enterprise architecture. For instance, inaccurate forecasting models directly degrade the precision of inventory valuation frameworks and general ledger postings, which in turn distort your financial reporting. Tax rule calculations and intercompany trade configurations also depend on the validity of your demand estimates, particularly when intercompany supply chains are involved. Managing these interdependencies necessitates the use of telemetry data to monitor performance bottlenecks before they escalate into systemic failures. Functional consultants must design user acceptance testing scripts that explicitly target edge cases, such as multi-site deployments where demand signals are fragmented across multiple geographic locations. Rigorous validation of workflow condition logic and data migration templates within the data management workspace is the only way to guarantee a scalable, fault-tolerant system. I will see you in the next lecture. Welcome back. In this lecture, we examine the mechanical processes behind the planning optimization engine and how to effectively execute master scheduling within Dynamics 365. When we initiate a master scheduling run, we are essentially triggering a high-performance calculation engine that translates demand into actionable supply requirements. The system iterates through the entire enterprise dataset, evaluating current on-hand inventory, existing safety stock configurations, and incoming sales forecasts. It performs a recursive explosion of bills of materials to determine the specific raw materials required for production orders while simultaneously processing open purchase and transfer orders. Because this calculation involves significant data volume, it is rarely done manually as an ad hoc task in a production environment. Instead, we rely on batch processing to handle the heavy lifting during off-peak hours, ensuring that the system remains responsive for daily warehouse and administrative tasks. The goal here is to achieve a balance where the planning run finishes within the defined operational window, providing planners with fresh insights every morning. Configuring the execution of these batch jobs requires a pragmatic approach to resource allocation, specifically regarding thread partitioning and filtering. By defining specific scope parameters, we can instruct the planning optimization service to focus only on those legal entities or specific master plans that require updates, rather than running a global recalculation that might be redundant. If you have a large multi-site deployment, you might partition these tasks to run in parallel, effectively using the server's multi-core capabilities to reduce total duration. It is equally important to monitor the batch job history to identify if certain processes are hitting bottlenecks, which often manifest as unexpected delays in your planning intervals. When we optimize the thread allocation, we are effectively telling the system how to distribute the workload across available compute resources, which requires a baseline understanding of your current data volume and update frequency. Once the batch job completes, the real work for the supply chain analyst begins in the net requirements screen. This interface provides a visual representation of the pegging tree, which is critical for understanding why a specific planned order exists in the first place. When you select a planned order, the system exposes the relationship between that order and the specific demand source, whether it was triggered by a sales order line, a forecast entry, or a minimum inventory threshold. This visibility is not just a convenience, it is a fundamental requirement for troubleshooting supply imbalances. If the system suggests an order that seems incorrect, the pegging tree allows us to trace backward through the chain of dependencies to identify whether the source demand originated from an incorrect forecast model or a stale safety stock setting. By inspecting these links, we move away from treating the system as a black box and start interacting with it as a transparent, logic-based model. Managing master scheduling also requires a strict governance model regarding the underlying technical configurations. You must ensure that legal entity overrides and number sequence frameworks are consistently applied, as inconsistencies here can lead to orphaned orders or synchronization failures across intercompany setups. Furthermore, since planning touches almost every module, from the general ledger for inventory valuation to tax logic for cross-border trades, any change in procurement or inventory parameters will inevitably ripple into your planning results. This is why testing is non-negotiable, particularly when you introduce new workflow condition logic or migrate data entities via the data management workspace. A robust configuration should always be accompanied by a suite of user acceptance testing scripts that target known edge cases, such as the intersection of intercompany demand and multi-site inventory transfers. See you in the next lecture. Hello, it is good to have you back for this session on firming planned orders. In this segment, we will explore the critical transition from system-generated planning suggestions into the actual execution documents that drive your supply chain operations. The core purpose of firming in Dynamics 365 supply chain management is to convert planned orders into real purchase, production, or transfer orders. Think of this as the bridge between the theoretical computational results of the master planning engine and the physical reality of warehouse and shop floor activity. When the system calculates a supply shortage, it suggests a planned order, but this remains a mutable recommendation until a user or a background process confirms it. During this firming process, the system replaces the planning record with a formal document using the configured number sequences and default order settings. You must understand that this step initiates the commitment of resources and, in many cases, financial liability. Without this conversion, your procurement and production teams have no actionable work to perform in the daily hub of the system. You can approach this task through manual intervention or by leveraging automated time fences to reduce the administrative burden. Manual firming is common when planners need to review action messages or evaluate vendor capacity, while automation works best for highly predictable items where steady-state replenishment is the norm. To optimize this, you should define grouping rules, which allow the system to consolidate multiple smaller planned orders for the same vendor into a single, cohesive purchase order. This practice is essential for logistics efficiency, as it minimizes shipping costs and streamlines the goods receipt process at your docks. If you do not configure these groupings, you risk fragmented procurement that complicates both internal administration and external vendor communications. Data integrity is paramount during the firming process because any gap in your default order settings will lead to transaction failures. The system validates the existence of mandatory data such as vendor associations, delivery addresses, and site management parameters before it commits the record to the database. If a record lacks a required field, or if a vendor is blocked for new orders, the firming process will naturally throw an error. This is not a system flaw, but a security measure designed to protect the integrity of your procurement ledger. You should always ensure that default settings at the released product and site-specific levels are perfectly aligned with your active business rules. Configuration of firming is deeply entwined with the broader enterprise architecture, including legal entity overrides and cross-functional dependencies. You must consider how firming triggers general ledger postings, impacts inventory valuation methods, and interacts with complex tax calculation rules. Furthermore, if your company operates with intercompany trade, a firmed purchase order in one legal entity might automatically initiate a corresponding sales order in another. This level of automation requires strict adherence to security rules and batch job scheduling, as these jobs often run in the background during periods of lower system demand. Administrators need to monitor these background services closely to prevent performance bottlenecks that could delay downstream logistics activities. Functional consultants must also design rigorous user acceptance testing to handle the edge cases that inevitably appear in multi-site deployments. This includes testing how your workflow condition logic behaves when orders are firmed for different regions or inventory profiles. You should utilize the data management workspace to migrate your configurations, ensuring that your firming parameters remain consistent across test, staging, and production environments. Always approach these configurations with a focus on fault tolerance. The goal is to create an ecosystem where the system manages the routine work, allowing users to focus on exception handling and strategic procurement. By keeping your setup clean and your telemetry monitored, you ensure that the supply chain engine continues to run without interruption or data discrepancy. Good luck on the rest of your study journey. Welcome back. In this lecture, we will explore the mechanisms required to synchronize supply and demand across multiple legal entities within a single enterprise ecosystem. Intercompany planning is essentially a distributed extension of standard master planning, where the output of one legal entity acts as the primary input for another. When we talk about setting up these relationships, we are moving from a contained manufacturing scenario into a networked supply chain. The fundamental objective is to enable the system to propagate demand signals horizontally across your various company entities. To achieve this, you must first define the intercompany trade relationships between the buying and selling entities. This implies that the selling entity must be defined as a vendor in the buying company, while the buying company must be recognized as a customer in the selling entity's environment. Without this foundational mapping, the synchronization of planned purchase orders and corresponding sales orders will fail to trigger during the master planning run. The integrity of your supply chain visibility depends entirely on these bidirectional links being correctly established in the Intercompany Trade tab within the vendor and customer master forms. Once the basic trade relationships are established, we turn our attention to the specific master planning attributes that drive the orchestration. The master planning setup requires you to indicate whether a company should participate in intercompany planning, which is a global toggle within the master plan parameters. Downstream and upstream pegging is where the complexity truly manifests, as the system must relate a planned purchase order in Company A to a planned sales order in Company B. You need to configure the planned order profiles to ensure that the system recognizes these intercompany dependencies as firm requirements rather than independent demands. If you do not explicitly define these links, the master scheduling engine will treat them as isolated shortages, leading to inaccurate procurement suggestions. Furthermore, you must verify that the item coverage settings across both legal entities are aligned in terms of lead times and safety stocks. A mismatch in these parameters often causes the planning engine to generate excessive stock or, conversely, frequent inventory shortages that frustrate warehouse operations. Execution sequence is the next logical step when orchestrating these multi-company manufacturing and distribution networks. In an enterprise with multiple companies, the order in which you run your plans is not arbitrary, as it directly impacts how demand flows upstream. You should generally schedule the downstream demand originating companies to process their plans first, ensuring that the necessary purchase requisitions or planned orders are generated for the supplying entities. This hierarchy minimizes the risk of circular references or phantom demand that can occur if you execute the plans in an illogical sequence. When configuring the batch jobs for these master plans, ensure that you are utilizing a consistent execution schedule that accounts for the intercompany transportation lead times. If your setup involves automated firming, you should ideally stagger these batch jobs to prevent resource contention on the application object server. Always remember that the goal is to create a seamless flow where the sales order in your distribution entity automatically drives the production requirements in your manufacturing facility. Finally, we must address the configuration mandates that keep this entire system stable and scalable. Rigorous validation of underlying parameters, such as number sequence frameworks and legal entity overrides, is non-negotiable for a production environment. You may find that specific items have different dimensions or tax rules depending on the legal entity context, and these must be managed via intercompany trade policies. Security role assignments should be audited to ensure that users have the necessary permissions to view or edit intercompany journals without compromising cross-entity data integrity. From a functional perspective, you should design your intercompany setup to be resilient against site-specific edge cases, especially when dealing with multi-site deployments where warehouse logistics might vary significantly. By keeping your intercompany trade configurations clean and well-documented, you significantly reduce the overhead required to maintain global inventory visibility. This level of diligence prevents the bullwhip effect and ensures that your resource allocation is truly optimized across the entire enterprise. I look forward to discussing our next topic shortly. Hello, welcome back. In this lesson, we will explore the master planning parameters, which serve as the foundational configuration for the entire planning engine. To understand the core of the planning engine, we must view the master planning parameters as the primary control mechanism for the environment. These settings do not merely influence one aspect of the supply chain, but act as a global framework that dictates how demand and supply are reconciled across all legal entities. When you initialize your planning scenarios, you are essentially setting the boundaries within which the algorithm operates. For instance, defining the default static and dynamic master plans is where you establish the distinction between your operational planning models and your simulation environments. If you fail to differentiate these correctly, you risk polluting your live requirements with experimental data, which is a common pitfall in enterprise implementations. By enabling capacity planning limits at this level, you ensure that the system does not generate overwhelming supply plans that exceed the actual throughput capabilities of your production units. This configuration is the starting point for anyone tasked with aligning the technical output of the software with the long-term strategic objectives of the enterprise. One of the most critical aspects of these global parameters is the configuration of safety margins, which provide a buffer against the inherent uncertainty of global supply chains. When you configure receipt, issue, and reorder margins, you are essentially instructing the planning engine to add temporal or quantitative padding to your supply chain activities. For example, a receipt margin might be set to account for the typical administrative delay between receiving goods at the dock and making them available for inventory reservation. If the system does not respect these margins, planners might find themselves unable to promise orders because the stock, while physically present, remains trapped in a state of pending receipt. Furthermore, enabling action messages is essential for maintaining an agile supply chain. These messages, which include instructions to advance, delay, decrease, or cancel existing orders, allow the system to output actionable feedback based on real-time shifts in demand. Without these active interventions, the planning engine would provide a static output, forcing planners to perform intensive manual audits of all existing purchase and production orders every time a customer order profile changes. Configuring these parameters is not an isolated task, as it necessitates a deep understanding of how they intersect with other functional areas of Dynamics 365. You might be tempted to treat these as purely technical settings, but they have direct ramifications for how the general ledger handles inventory valuation and how intercompany trade is executed. For instance, if your intercompany planning chains are not harmonized with your global parameter settings, you will inevitably experience discrepancies in planned order generation across different legal entities. Moreover, administrators must pay close attention to the number sequence framework and the security role assignments that govern who has the authority to modify these global triggers. A single incorrect adjustment to a parameter relating to the planning horizon or the inclusion of expired inventory can result in massive system-wide calculation errors that are frustrating to deconstruct later. This is why we advocate for a structured approach. Validate your base configuration. Test against specific demand scenarios using the data management workspace to migrate data entities, and ensure that your batch jobs are scheduled during periods of low activity to prevent performance degradation. Finally, let us consider the ongoing maintenance of these parameters as a performance engineering exercise rather than a one-time setup activity. In a high-volume manufacturing environment, the complexity of your constraints can quickly outpace the capacity of your server resources during the master scheduling run. Functional consultants should prioritize the development of user acceptance testing scripts that specifically target edge cases, such as multi-site demand dependencies or complex workflow conditions. Utilizing telemetry data allows teams to identify if specific calculation logic or coverage groups are introducing bottlenecks into the execution process. By maintaining a disciplined approach to how these global settings are governed, you create a scalable ecosystem that remains resilient even as the enterprise grows. The goal is to move beyond mere configuration and toward a deep technical competence in how the underlying algorithm processes its environment, ensuring that the technology always serves the business goals rather than constraining them. I will see you in the next lecture. Welcome to the final chapter, where we synthesize the entirety of your journey through the Dynamics 365 supply chain management landscape. We will now consolidate our understanding of how disparate modules function as a unified, cohesive ecosystem. In these closing moments, we should reflect on the architectural integrity required to pass the MB-330 exam and succeed in practical deployments. We have traversed product information, inventory structures, procurement cycles, and warehouse logic. Yet these components only generate value when they communicate fluidly. The supply chain is not a collection of silos, but a continuous stream of data points moving from planning to execution. When you configure a warehouse zone or a location directive, you are fundamentally affecting how master planning perceives availability and how your ledger accounts for inventory valuation. This interconnectedness is the primary hurdle for practitioners who view tasks as isolated configuration steps. You must cultivate a mental model that traces a single stock movement through its ledger impacts, its warehouse tracking dimensions, and its influence on future replenishment signals. Viewing the system as an integrated web allows you to anticipate how a change in a legal entity override might ripple through your intercompany trade configurations. As you prepare for the rigors of the certification exam, your focus must shift from knowing where a button is located to understanding why the parameter exists. The MB-330 exam test creators prioritize your ability to troubleshoot logic rather than just recalling menu paths. Consider, for instance, the implementation of security hierarchies. This is not merely an administrative exercise, but a fundamental control layer that dictates data integrity and compliance. If your role assignments lack the necessary granularity, the downstream consequences manifest as inconsistent data entry or unauthorized modifications to critical master planning parameters. Similarly, your mastery of batch job execution schedules ensures that system performance remains optimal during high-load periods. A consultant who understands the telemetry of the system, how jobs queue, how workflows trigger, and how data entities interact, is far more valuable than one who follows a checklist without questioning the architectural rationale. Configuration mandates a rigorous validation mindset, particularly when handling the complexities of multi-site environments and complex taxation rules. When you design user acceptance testing scripts, you are effectively performing an audit of your own logic and foresight. You must target the edge cases. What happens when a wave process fails? How does the system recover from an interrupted inventory journal? And are your data entity migration templates robust enough to handle volume spikes? Ensuring these elements work in concert requires a deep understanding of the dependencies between general ledger postings and inventory valuation methods. Remember that error patterns often emerge at the seams where one functional area hands off to another, such as the transition from a purchase requisition to a firmly established purchase order. Your goal is to design an ecosystem that is not only functional at launch, but remains scalable and fault-tolerant as enterprise requirements evolve over time. Think of the system as an implementation of a state machine, where every action pushes the entity through a predefined lifecycle. Whether you are dealing with unit sequences or product lifecycle states, consistency is your most important tool for maintaining long-term stability. The complexity of Dynamics 365 can be intimidating, but it becomes manageable once you recognize the underlying patterns of request, fulfillment, and reconciliation. When you encounter a technical obstacle in the future, reach for the principles of flow. Identify the source of the demand, verify the configuration parameters that enable the supply, and trace the financial outcome. This methodological approach will serve you throughout your career, far beyond the confines of a certification exam. By focusing on the flow of information across modular boundaries, you ensure that the solutions you architect provide tangible business value to the organizations you support. I trust that this comprehensive overview has clarified the relationships between these modules and solidified your readiness for the assessment. See you in the next stage of your professional development.